Okay, I think we are live. F it, we'll do it live. Oh God! All right, here we go. Let me get this out of the way. All right, guys. Well, thank you everybody for joining. And I know this course has been pending, and it was one pestilence after another at the house of Romero, and I appreciate you guys' patience. And I'm happy we're just at least launching this part way today. All right. So, yes, patience does win the day. Apparently also wins the quarter. All right. So, everybody, welcome to Professional Tape Reading Strategies. Thank you to Monica for helping me with some of the slides here. As usual, she puts me to shame in terms of productivity. I give her 60 slides to do. She was done in an hour. I was like, what am I doing with my life? Oh my God. Anyways, thank you, Monica. You rock. Appreciate you as always. Okay. Welcome everybody to Professional Tape Reading Strategies. Here are our mandatory disclosures. Please read, analyze, internalize. And here's number 2. Go ahead and analyze, internalize, and vandalize. Absolutely, there we go. Excellent. Welcome to Professional Tape Reading Strategies. At this point, if you don't know who I am, I don't know what to tell you. It is me. It's I, JR, full-time professional trader since the Cambrian or pre-Cambrian period. Right, vet trader. And it is a pleasure to be with you all today. So, Volume 1, the why. This course is laid out in order to really explore the fundamentals, and then the advanced topics in tape reading. Okay, today we're going to focus on the why, both in terms of psychology, behavior, and cognition. And later, I'm not sure I don't think we're gonna get through it today, but in this first volume, we go deep into profiling markets, understanding volume price analysis, and understanding why markets move the way they do, and what to look for when we're reading the tape. The traditional late 90s, early 2000s notion of tape reading was a guy looking at a level 2 box and understanding, very cursory understanding of order flow. And in my opinion, between the 1920s and the 2000s, a lot of magical knowledge, just amazing tape reading knowledge, was lost and then slowly refound, that really redefines what tape reading is. Okay, tape reading is not just looking at level 2 in time and sales. It's really looking at the entire heuristic footprint of the market as a whole without having your head explode. It's maximizing the number of data points you look at until you reach a point of diminishing returns. Okay, and so that's what we're going to explore. And Volume 1 really is going to look at the why. Why does the market move a certain way? Okay, and knowing that we have a point of diminishing returns in terms of the amount of information we can pay attention to and absorb. Okay, knowing that, then the question becomes, once we understand the why, okay, we focus on the when and the how. Meaning, okay, now it's time to get very, very specific and look at those prints, look at that order flow. Okay, so the why is going to help us understand where those inflection points are, okay, and why they are important. Make sense? All right. So let's go ahead and get started. So what are the non-random predictors of price development? These are quotes from Richard Wyckoff, who in my opinion is one of the greatest traders who ever lived. Successful tape reading is a study of force. It requires ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. So you always hear me talk about, monkey knife fights and upper hands and the battle and so on and so forth. If you didn't know what I was talking about, you would think I'm referring to some kind of wild S&M circus for monkeys, okay? But really the market is all about that struggle between buyers and sellers. And the Richard Wyckoff's quote here is right on point. Successful tape reading is a study of force. It's a study of that battle. Second quote I love. Man or woman seldom makes success of anything. That is true of trading stocks, business endeavors, or even hobbies. Success in trading usually results from years of painstaking effort and absolute concentration upon a subject. It requires a devotion of one's whole time and attention to the tape. He should have no other business or profession. A man cannot serve two masters. The tape is a tyrant. The tape is a tyrant is my favorite Richard Wyckoff quote. I always say day in and day out, okay? I do what the chart says, okay? I do what the tape says. I do what the market says to do. And today we're going to look at understanding, okay, how we can best understand what the market says to do from a psychological perspective. This is not a psychology course, okay? These are basic psychology principles that we're going to discuss, but they're very, very important. And I'm sure of it, trader. I'm absolutely sure that that's true, yeah. All right, so let's go ahead and go on here. So this is the old-fashioned ticker tape. I felt like this deserved a couple of slides here just to pay homage to the giants on whose shoulders we stand today. So tape stock price information was transmitted over telegraph and telephone wires. I mean, as unbelievable as that sounds, until 1970. It was a paper strip that was ran through a machine called a stock ticker. Out of curiosity, is anyone here old enough to have seen ticker tape live? I'm just curious. It's absolutely amazing. GWS, wow. For real, David W? I mean, I've seen it, but not, obviously not in production, which printed abbreviated company names followed by numeric stock transaction, price and volume information. This is a picture of a New York City broker. And as you can see, it was very much sometimes a group effort, and you would literally go through the tape sequentially, right? And you would look at the tape as it came out in time, hence the term tape reading. So, this is a closer look at ticker tape, right? You have the ticker, and these are the fractionalized price levels. Big nod of the hat to Peter Sellers. I saw this picture, I had to include it. So, what is tape reading? So, tape reading is the analysis of real-time and past order flow in order to make determinations of probabilities of future price movement and the projected timing of those movements. So we started in 1870 with the ticker tape, and the inventor was Edward Callahan, who in 1867 invented it and went on to form ADT after leaving American Telegraph Company. And it really was a remarkable change in markets, because before ticker tape in Wall Street, they used to have what they called runners, and it was literally a bunch of day messengers who would run back and forth between the brokerages and the exchanges, bringing people, quote unquote, real-time information. Can you imagine having to send somebody on a on a horse, or in a jogging outfit, to figure out what the bid on Tesla is? I mean, it's absolutely your edge would be a kid. Yes, a kid on a motorcycle. Exactly. So we had some earlier versions of stock tickers. At the time, obviously, this was a really, really important development, and it was an arms race of information. The universal stock ticker machine, also developed by Thomas Edison in 1869, used alphanumeric characters with the printing speed of one character per second, which at that time was light speed information. Okay, like, that was a revolution. Imagine going from the exchange to the broker, okay, within a few seconds. That was a pivotal change in information, and with faster information usually comes greater liquidity, greater interest, and accessibility. So we had quite a revolution in information management with the development of the ticker tape and tape reading, and it was it's hard to quantify today what a massive change that must have been, to go from runners and dudes on mules and motorcycles and whatever else to having the broker actually be able to determine the tape in almost real time. So I often use the phrase, when our first scalp try 1 week. So I often use the tape. I often use the term crossing the Rubicon. I'm sure you guys, a lot of you guys recognize this painting. This is Adolphe Ivan's 1875 painting. It was obviously a romantic period painting of Caesar crossing Rubicon. Why do I constantly talk about crossing the Rubicon? Because it's really the journey every trader must make, cognitively and behaviorally, to where we're, maybe making some sense of the markets or not understanding the markets at all, to being able to successfully execute in the markets. Okay, and it is a transformation, the most powerful transformation any trader goes through, and it's circuitous. It's not like a Boolean type of event where it's a yes or a no. I feel like a lot of traders cross the Rubicon, then they uncross it a couple of times, then they chill, then they cross it again, and finally they make landfall, hopefully permanently. So what does that really entail? Well, it really is the beginning of the journey to think like a trader. So a lot of novices Venmo me, bro. I got you. I'll send you a pin coordinate. So it's really the beginning of the journey to think like a trader, right? Amateurs are obsessed with strats, right? They buy courses. Johnny Rocket's got the Johnny Rocket 3000 strategy, and they're simple and easy, and all you have to do is follow Johnny Rocket, okay? And typically amateurs trade with very little foundational knowledge. They have dumb rules. They have indicators that work some of the time, don't work other times, depending on what the market is doing. And you deal with all kinds of weird cognitive dissonances. And I'm sure a lot of you who are maybe beginning to trade in 2020 and thought you were geniuses by December 2021 experienced the dissolution of those technical cognitive dissonances in the most violent and unpleasant of ways. I look at a lot of you today, and you're 10 times the traders you were those years, and a lot of your it took you years to finally succeed again in the markets. I mean, that's how brutal cognitive dissonances can be, right? So what's the difference between amateurs and professionals? Well, professionals are typically multidimensional thinkers with a deep foundational knowledge of the market, okay? And they're obsessed with one thing and one thing only, which is price, right? Price is truth, and price is expressed in the battle between supply and demand. Everything else takes a back seat in that particular struggle. So professionals really have a very, very different mindset and cognitive filter to amateurs in a very, very different behavioral framework with which they trade. And that is what crossing the Rubicon truly entails, okay? So in terms of, there's a lot of stuff that, here I made a cheesy pyramid here, in terms of the things that you're going to need to really master to be able to succeed in this business. Today's talk will really focus on psychology, cognition, and behavior, right? Obviously, game planning, very important, and trade plan is the ultimate. Now, game planning, obviously, okay, is your short-term operational plan that gets decided by your overall training plan. So today we're going to talk about psychology, cognition, and behavior, because oftentimes we drink from a water hose of information, right? And that water hose of information, that stream of information gets mixed in with our biases, our fears, our emotions, and our logical fallacies. And what comes out the other end is not in any way reminiscent of what came in, right? And so in order to, the tape reading really answers the where, okay, and the why, okay? Okay. Once we have a clear understanding of what is happening, our questions are where and why, right? Trade location. Sorry, I'm a little bit out of it. I meant the where and the how. Okay, that is what tape reading is all about. The first requirement is the why. Okay, like, why are things happening, and are we sure that they're really happening? Okay, and for that, we need to refine our cognitive parallax. So we're going to be talking a lot about that today. I know this isn't as exciting as looking at recorded real-time tape, okay? The problem that most of you have who haven't really yet crossed the Rubicon is that you're looking at the wrong thing for the wrong reason, okay? Typically we call that Plato's cave. And then when you finally execute, you're not sure if you're executing correctly because you never answered the why. And then when you win or lose, you're not sure if you won for the right reason or lost for the right reason. This spiel should sound familiar to a lot of you guys who've been in the room with me for a while. Okay? So, yeah. So this is us, okay? This is the market. We're dealt with a fire hose of information. Markets are multidimensional, right? And we're told that if we get this piece of software called a chart, that in 2 dimensions, okay, so here's your sort of dimensional example, right? If this is the true market, right, and it works in like 5 dimensions, you have time, price, and then you have obviously like a volumetric analysis that you need to look at, and on top of that, there's all kinds of qualitative analyses and intermarket relationships that we look at, right? There's so many different variables that we look at that are multidimensional, right? And we're told by our broker that if we just download the TC3000 with Ralph's plugin, no offense, Ralph, I'm just kidding, love you, bro, that we're somehow going to be able to make sense of what's going on, okay? So how many of you guys are familiar with the term parallax? Anybody not heard of parallax? Okay. So parallax is basically an optical offset, right? It deals with offsets in perception. There's a lot of you gun nuts in the room who are very familiar with parallax, right? CT, I'm sure you've regulated the parallax on your $8,000 scopes when you're shooting long distance. Love you, bro. It's okay. I'm a gun nut too. Anyways, so I'm gonna use the example of a sniper because it's a really good example, or a marksman. Okay, so you're out there at the range, okay, and this is your scope, okay, and you've got your target here in the middle. Okay, I'm gonna make the target red or pink, so this is your little target in the middle, right? And you're looking at your target, okay, and you've got your crosshairs right over the target, just like in the movies, and you shoot the target, okay, and it's like 4 feet off. You're doing a 1,000-yard shot, and the bullet lands, the round lands like 3 feet away from the target, okay. So you realize, okay, there's some variables I didn't account for. All right, so shooters in the room, what are some variables, some multidimensional variables that visual perception alone can't account for? Wind, distance, elevation, what else? Earth's curvature, it's a real thing, yeah. Gravity, obviously. Humidity, temperature, yeah. Oftentimes you'll zero a rifle at, in like, say, the lowlands of Tennessee, and you'll take an airplane ride to Idaho, and you'll go shooting with me at 5,000-7,000 feet, and bullets are not going where they're supposed to go. Okay, so shooters have to account for all those dimensions that contradict, okay, their current visual input. Okay, and on top of that, scopes themselves actually will have a parallax knob. So you have to deal with multiple dimensions, multiple variables instead of two, right? Like just say, for example, elevation and velocity. Okay, so that is the perceptual challenge that we all have as traders, right? We're dealing with very, very complex, multidimensional markets. Okay, and try to understand that supply and demand analysis and the parallax that we go through is complex, right? Because not only do we have to summarize the information we see, okay, but then it gets displayed for us in the most stupid of instruments. The chart is the chart is a miracle on one hand, okay, but on the other hand, like the chart is like the internal combustion engine of trading, okay? But like the internal combustion engine, like anyone else feel like the internal combustion engine's gotten a little old in the 21st century? Like we could use better tools? Well, it's the same thing is true with the chart. The chart is in some ways, a very poor two-dimensional rendition of like a 5 or 6 dimensional problem, okay? And on top of that, right, you've got to deal with, I just affectionately call this your stupid psychology. And by your stupid psychology, I mean my stupid psychology. Okay? To make matters more complicated, in this parallax, okay, you have to adjust for, just like a shooter may have to adjust for the curvature of the earth, or the humidity, or the windage, the temperature, right? We have to adjust for our own logical fallacies, our own perceptual biases, our own cognitive biases, and more, okay? So when we talk about parallax, okay, that is what we're talking about. And until you can figure this out, okay, answering the why, so you can get to the where and the how, is impossible, okay? How many times do we have a situation where, like, I draw a chart, I draw lines in a chart, and call out a trade that you wouldn't have thought was a good trade idea. In fact, you would have thought it was a terrible trade idea, and it ends up working like really, really well. Does that happen to you guys? With my, when I started trading in a floor with Big Al, my mentor, it was like watching, and I am nowhere I'm not comparing myself to Ali Quinta in any way, shape, or form. What I'm saying is, I had not really figured out my own perceptual parallax yet. And it seemed to me, it was like, I felt like one of those monkeys in 2001 Space Odyssey, banging on the monolith, okay? And this guy would just come up and be like, okay, watch the rebid on, Palm or Netscape at whatever. And it was just like, it was such a clear parallax for him and such a murky picture for me. So, getting through this problem, okay, is absolutely essential to tape reading. If you're looking at tape and you don't understand the why, and you don't understand the where, and where to look for it, okay, you're going to be drinking from a fire hose. It is impossible. It is impossible to make any kind of cognitive determination as to what's important and what's not. You guys understand what I'm saying? So this is the crux of what we're going to discuss today. We're going to discuss some key, really important concepts in terms of trader development and cognition, and that's going to lead us to an in-depth volume price analysis discussion. Okay, so we can truly understand the why, and then volume 2 of this course, which is coming, it's done, is going to be the actual in-depth tape reading strategies through time and sales and footprint charting, so we can put it all together. All right. So, a quick note about chaos theory. So, you guys are all familiar with chaos theory, right? We are ultimately looking at an apparently chaotic system, trying to understand the human intent behind the bars and assign some kind of orderly cognitive interpretation to it so that we can derive a decision. Okay? Trump. Wait, it's too early for Trump jokes, man. I just can't. All right. So, using chaos theory, a change in price is determined through mathematical predictions of the following factors: a trader's personal motivations, such as doubt, desire, hope. Right, we're going to talk about all those psychological factors, all of which are nonlinear and complex. Changes in volume, acceleration of changes, and momentum behind the changes. So, Bonini's paradox. Type 11 if you've heard of Bonini's paradox before. This is so important. So important. Okay. So, as data sets become more complete, they become more complex to analyze, process, and understand. I'm looking at you, Andrew. I love the ponytail, but okay. So we have two edges of the spectrum. Okay. Oh, Andrew knows I just like to rub him. To rib him. So we've got data scarcity on one side. Okay. And we've got data overload on the other. The importance behind understanding Bonini's paradox, okay, is that there is a diminishing set of return once you reach magnitude of cognitive efficiency, meaning once you have... sorry. I apologize. Once you reach your point of maximum cognitive efficiency, okay, which is the point where you've gathered all the necessary data points enough to form a supply and demand picture in your trade analysis. Beyond that, okay, beyond this point, you're going to achieve nothing but diminishing returns. Paralysis by analysis. You stole the word right out of my mouth, Todd. Exactly. So this is signal to noise ratio. Exactly, Ash. So our purpose, right? And I always say we're not trading against a chart. We're trading against people, right? Our goal ultimately needs to be to get as best of an understanding of human intention behind the bars. All right, we have a supply and demand picture. What is the human intention behind the bars? Once we reach that maximum cognitive efficiency, everything else, okay, that data overload leads to paralysis, or worse, okay, it will lead to bias overload, and we may start thinking in terms of biases and logical fallacies, and that is a major step backwards. Okay, so maximum cognitive efficiency means intersection of proper technical analysis and risk management. Okay, you guys definitely never done that, Andrew. So I'm always talking about, when I rant in the afternoons with you guys, I'm always talking about the 3 boxes, right? So, technical analysis, behavior, and cognition, right? Okay, so in order to, once you find maximum cognitive efficiency, okay, and that may be different for everyone, right? Some traders are just trading with volume and candles. They don't even have moving averages on their chart, and they do great, okay? Some traders, in order to reach maximum cognitive efficiency, deploy moving averages, they deploy volume price analysis, okay? They watch order flow, like footprint charts. I'm one of those people, okay? I have not been able to find as much success in just trading a chart with 0 indicators in volume. Could I do it? Yes, I could do it all day if I could, but that's not my point of maximum cognitive efficiency. It's different for everyone because we each have a what? We each have a unique cognitive parallax through which we view the market. When people ask me all the time, JR, what setup should I trade? What is the one thing I always tell you guys? I cannot teach you how to day trade. Trading cannot be taught, okay? The only thing that can really be taught is how to think about the markets. How to think about the markets is something that can be transferred from person to person because it is a methodology. How to trade, okay, is an art as much as it is a science. It is something that is completely, that decision-making process, okay, the execution spectrum of the maximum cognitive efficiency equation is unique to your parallax. It's unique to how you view the market. I mean, you guys have seen, say, for example, Kathy trade versus, someone like, for example, Kelly. Wildly different ways of looking at the market, both successful, okay? Each of these traders has found what their point of maximum cognitive efficiency is, how their parallax works, so that they can maximize their execution decisions, okay? That is there, and that's the intersection of proper technical analysis and risk management. That is how that is how you get to a proper execution, place of execution, and so on and so forth. Okay, so you guys have all seen this before. I'm trying to put the pieces together of all the different topics we've discussed in the past, so they maybe start to intersect for you guys now. My particular technical parallax is a very specific approach, right? I always look at the market from a top-down basis. Structure first, price action, patterns, order flow, and then finally tape reading. Now, this is a course about tape reading, okay? But before we get to the nitty-gritty of tape reading, we have to understand how to interpret this multi-dimensional fire hose of information so that we get from input to processing without completely corrupting the data. Does this make sense so far, or is this really is it really out there? Okay, so you guys have seen me draw this 1,000 times. I guess we have a lot of new members, so I don't want to just assume that. But you guys remember the rabbit or the duck? Okay, so this was used by a famous psychologist, Joseph Jastrow. And it's a Ludwig Wittgenstein image, okay? And it really is all about how complicated our sensory perceptile organs are, okay? It's not just our eyeballs, right? It's our mind. So the cognitive parallax, right? We go from analysis here. We go from analysis here, okay, to perception, okay. We have to cross that bridge, and you know, it's a stream full of crocodiles and sharks with laser beams and, you know, poisonous jellyfish, okay. It's the cognitive dissonance that you feel every day, the logical fallacies you cling to, the cognitive biases you cling to, right? And those will affect how you process that information through your technical analysis, okay? A lot of you guys, for example, say, "Oh, JR, look at that bear flag," and that you know, I'm looking at this beautiful bear flag. I want to go short, and we'll say, well, that, you know, if you apply some basic multidimensional analysis, you know, some people call that fractal analysis, to the pattern in question. What do you see? Are you near demand zone? Yeah. Are you near a major support pivot? Yeah. Are you over your mid-length moving averages? Yeah. So is it a pain trade or is it a continuation bear flag? Oh, right. And then all of a sudden, instead of looking at a rabbit, okay, you change your parallax completely, and now what do you see? You see a duck, right? This is a major challenge. So today we're going to talk about, okay, these alligators in the moat, okay? If you're trying to get into that castle of execution, the castle of success, you have to swim through that moat, right? So we're going to talk about these logical fallacies, these cognitive biases, and the dissonance that greatly affect your perception and your behavior in negative ways. So, these are the... Oh my God, I'm sorry, guys. This is great. I don't know why that might... So these are the paths we take, right? We can take paths to proper execution. Amateurs are unable to travail the cognitive parallax, right? They have not yet crossed the Rubicon. And so today we're talking about that. We're talking about the things we need to be aware of in order to properly traverse the cognitive parallax without falling prey to it. Okay? What's more, here are three amigos. Okay? Risk, reward, and probability. Now, is it possible to properly assess risk, reward, and probability if we're drowning in the river of cognitive parallax? If we are so affected by logical fallacies and cognitive biases and cognitive dissonance, and what's worse, the emotions that those generate, are we actually able to calculate probabilities, cognitively speaking? Are we able to calculate those probabilities? Yeah, most of us can't. And I fell prey to that for many, many years. And it's, you know, and if you're dealing with these problems, okay, you are in the majority, not in the minority. You are being human, okay? So, just one more example here. W.E. Smith, 1915. What do you guys see? I'm sure a lot of you guys have seen this one before. Okay. I did this experiment with one of my kids. Okay. Actually two of my kids, and they both said, "Oh, it's a lady turning away." And it took them, about 5 to 7 minutes to find the old one. I said, "There's an old woman in the picture." Okay? There's an old woman in the picture. Can you find her? Okay? This is fascinating. They couldn't find her. They just could not. You know, they said, "Well, this is her chin line here, and this is her little nose, and Dad, obviously this is her ear, right?" And I said, "Well, there's an old lady in the picture. Where is she?" They finally gave up. Okay, and then I show this is the chin of the old woman. This is her mouth. This is her big old schnoz. Okay, and this is her eyeball. What's fascinating, this is what's fascinating, okay? Jeff, that's good. What's fascinating, guys, is that once my oldest son, Harry, who's, is my trading pupil, once he saw the old lady, he could not see the young one anymore. His mind became so fixated and parallaxed into that pattern that he was actually unable for a little while. It's like his brain was frozen. Okay? And so this is the problem of cognitive heuristics. Okay? We are monkey people. As Joe Rogan would say, right? We are very much descendants of apes, and we are primates. And we developed in the brain something called cognitive heuristics. It's an automated decision-making part of the brain. Cognitive models are built for speed and adrenaline, okay? They're not built for analysis of financial markets, okay? This is, the wife and the mother-in-law, right? And in the spectrum of perception and execution, our brain is very much designed. Okay, the brain's cognitive heuristic model is designed to make decisions very quickly. You can't see the mother-in-law. Isn't it hard way? Like, our brains are designed so that in the African savannah, we can look through the bushes and recognize a pattern and say, okay, is that a saber-toothed tiger about to eat me? Or is it a bunch of bushes, right? If it's a saber-toothed tiger, run like hell. If it's a bunch of bushes, look for berries. I'm obviously oversimplifying this a lot, but for the purposes of this discussion, okay, the problem is that the brain, and this is one of the cognitive biases we're going to talk about, the brain looks for primal patterns to make really fast automated decisions on stay or flee. Okay, not even fight or flight, stay or flee. That is the question. And what this ends up turning into for a lot of traders is you end up seeing things in the market that seem really obvious, okay, but are not. And what happens? What happens when you become overconfident? You think you see things that aren't there. Well, you end up making execution decisions that are totally unmoored from reality. Does that make sense? Oh, that's terrible, Selrek. I'm sorry to hear that. What a loss to humanity. Does this seem like a problem that maybe some of you guys experience on a very regular basis, where you look at a trade after you took it and you're like, "Oh Lord, what the hell was I thinking?" Okay, so this is a problem with cognitive heuristics. They save us when we're hiking through the Amazon. They're built into our brains. They're not so helpful when it comes to analyzing highly complex, chaotic systems like markets, like financial markets. Okay, and so part of crossing the Rubicon is remodeling our perceptual parallax, our cognitive parallax, and our cognitive biases and behavior, so we can get beyond this. Ultimately, the path to becoming a professional trader is a massive change in cognition, behavior, and how we think about the markets. I feel like not putting another trade on until this is mastered. Probably you're funny. Okay, so Daniel Kahneman, this guy is the Jimi Hendrix of finance. Okay, Nobel Prize winning economist. A lot of you guys, have read through the Tversky experiments on loss aversion. Well, all of that comes from Kahneman's prospect theory. Okay, prospect theory is a behavioral economic theory that describes how people make decisions. Okay, when faced with uncertainty and risk, it posits that individuals are more sensitive to potential losses than to potential gains. It's called the concept that you guys are familiar with it is loss aversion, right? It suggests that people tend to be risk averse when it comes to gains and risk seeking when it comes to losses. Does that sound familiar? You're risk averse when you see you're up $10 in your P&L, no comment, and you're like, oh, hoo-hoo. You take the money, but somehow you're completely willing to let that $800 loss keep running and turn into a $5,000 loss when you were ready to take a $10 win. Okay, so this is prospect theory here in a nutshell. We don't need to really get into the weeds here because it's not so important. But basically, the idea that you have less, a $50 loss gives more pain as compared to the joy of a $50 gain, right? It's as simple as that. And in terms of outcomes, behaviorally, you are ultimately hardwired to avoid pain more than anything else. Right? You flee from danger, avoid pain is built right into our central nervous system, and it is ultimately what drives. It is ultimately what drives our cognitive heuristics, right? And our decision making. And it's really, really difficult to rewire. That's why I always tell people there's a difference between technical analysis I can teach you and thinking about the markets I can teach you and learning how to trade, okay? Becoming a successful trader means crossing that Rubicon. It means overcoming loss aversion and letting trades work, which is simple in theory, very, very complicated in practice. Okay, so the key features of prospect theory: people feel pain of a loss more strongly than pleasure of the equivalent gain. Decisions are made relative to a reference point, which is often the current state or status quo. Right? Remember, I always talk about this chronocentrism, right? The logical fallacy we have as traders of placing undue focus on the current moment we're at in time. Like, for example, do you guys ever take a trade at 1:30 in the afternoon on a stupid buy setup that maybe has a 20% chance of working, and you look back on it at the end of the day and you're like, what the hell was I even thinking, right? Well, you gotta make this personal. Okay, so that is the reference point problem, okay? Diminishing marginal utility. The value of gains and losses diminishes as the magnitude of gain or loss increases. I'm sure we've been through all that as well. People tend to overestimate the likelihood. This is probability weighting. People tend to overestimate the likelihood of low probability events and underestimate the likelihood of high probability events. This is a major problem, okay? And finally, the certainty effect. People tend to prefer certain outcomes over probabilistic outcomes, even if the probabilistic outcome offers a higher expected value. So, you guys always hear me talk about, have you backtested your setups? Do you know what probability, I don't know, say for example, an Evel Knievel has of working between 9:30 and 12 o'clock when you're coming out of a deep oversold condition and you're retaking point of control. Like, that's a super high probability trade, right? Instead of waiting for that, a lot of you guys try to take the V bottom, right? So this is just a stupid example, right? But you have a massive selling climax here, okay? And maybe no technical indication that this is in fact the V bottom, okay? And for whatever reason, through the certainty effect, you try to catch this bottom, it turns into an H, stops you out. Because of loss aversion, you're letting that loss ride when you could have just waited for that higher pivot low, waiting for that 21, waiting for the shakeout, and taking the Evel Knievel. Right? Certainty effect. Is this ringing a bell, people? This is a real problem with a lot of traders like to gunsling bottoms, without enough information. Okay. So, the two phases of prospect theory. Editing phase. This phase involves how individuals frame or organize information presented to them, which is what we're focusing on today. Okay. This entire talk today is about how we frame information. It is very, very important. And then we're talking about the evaluation phase. The phase involves evaluating the potential outcomes, making a decision based on perceived value of each option. The key phrase here is value, right? We're talking about expected value when we trade. What is the probability of a certain trade working? So, I'm sure you guys all recognize this meme, right? It's this is you, and this is the market, right? This is a screenshot of. That's right, little Curbster. I know you do. How much easier is it for you when you do that, though? How much more mentally at ease are you when you do that? 100%, right? We don't predict, we react, right? That is one of my mantras that I tell myself every day. So this is a screenshot right out of the Stanley Kubrick classic 2001 Space Odyssey. So these are the I guess they're like Australopithecus africanus, so like Lucy type apes, right? They're worshiping the monolith. So that is us. We're the apes, and the market is the monolith, and we're trying to make sense of it. Okay, this is the intelligence paradox. This is really important to understand clearly. Okay, the intelligent paradox. The same cognitive biases that enable the rise of highly intelligent humans are the same biases that hinder this that hinder this intelligence in various modern life scenarios. Okay. We are hardwired through 200,000 years of human development, okay? And by the way, this little sliver here is not built to scale, okay? This is modern humans, okay? This is modernity, industrial modernity. We are, if this was to scale, okay, this would be like a very, very thin hairline type of line, okay? We are wired in terms of the descendants of primitive human society to react to stimuli and information in order to survive in the African savannah, okay, and in the Swiss Alps with fighting the Neanderthals. We are not hardwired to solve modern problems, right? Our primary issue psychologically and cognitively is that we have an operating system deficiency, okay? Our operating system was built, I'm talking about the brain, the mind, okay? Our operating system was built to solve modern problems, our operating system was built to solve primitive problems, okay? And we're operating, currently solving modern problems with a very primitive human operating system. That is why crossing the Rubicon is absolutely essential to understanding how to execute properly as traders, okay? And this extends way beyond trading, right? The fact that we have countries with presidents that have nuclear armaments, scares the heebie-jeebies out of me personally, because we're still very much monkey people, but now with nukes, okay? So this is the jungle. This is the cognitive jungle of your mind. This is from, I think, cognitivebias.org. Okay, I just did a straight up screen capture for you guys. This is just a snapshot of the cognitive bias codex that affects all of your decision making all the time. Your brain is a jungle of biases, fallacies, and emotions that contaminates your decision making every day in the market. Okay, it's a freaking minefield. Okay, This is an absolute minefield that needs to overcome. So you may be asking yourself, JR, what does this have to do with tape reading? Can we please skip to the chart porn? Not yet. Okay? Not until we go from monkey people to Wyckoff people. I'm just using Richard Wyckoff here, obviously, as an example of a highly evolved trader. It's just a meme. I don't need to start a technical analysis war. Okay, I'm just saying the true journey in order to be able to read tape and be able to execute it properly, okay, is mastering our cognitive parallax. So we're going to. It is a nice blunt. Yeah, I rolled it up myself, bro. Yeah, this is Wyckoff friggin' dubstep edition. All right, so we're gonna start with the availability heuristic. Cognitive biases cannot be changed. It's like a virus that lives in your brain. You can choose to ignore them or not. You can choose to look through that lens or not. It's a great question, Jeff. It's a great question. Yes, that is Thug Life Wyckoff. Okay. So we have about 30 problems we need to overcome as traders on a daily basis, and we're gonna go through them one by one. Okay. The first is the availability heuristic. That is a tendency to rely on information that is readily available instead of considering possible alternatives. Okay, relying on mechanical signals instead of building a trading context. It's one of the reasons why thinking about simple setups is comfortable and thinking about elaborated trading concepts is uncomfortable. If you're, say your name is Johnny Rocket, okay, and you're just interested in cashing in and selling some courses and selling some strats, are you going to make it easy or hard? If you're selling trader education, are you going to want people to be like, I can do this. This is easy. All I have to do is flip the flux capacitor when the 8 crosses the 21 and the doohickey flashes red, right? Exactly. This is the primary problem with the trading industry, is they try to sell you on this fallacy, and it's called the availability heuristic, okay? We're often lured by really simple signals, okay? Because we suffer from that cognitive heuristic we described earlier, right? We like to look at simple signals. Is that a tiger in the bushes about to devour me or not? So cognitive heuristics work into all of these problems. So the availability heuristic is a big one, okay? And it's most found with novice traders, okay, who are really trading indicators. Let me ask you guys a question. Of those of you guys who started using indicators, okay, how many of you actually took the time to figure out how they worked? I certainly didn't. You did, Vet Trader? That's really impressive. When I started, I was dumber than a rock. And I was like, okay, when the Mach D crosses the doohickey, and I was like, okay, that means buy. To me, when I started trading, the market just seemed like a game of Dungeons and Dragons with magical spells. Okay, I had no idea what the hell I was doing. And because it was the late 90s, I was just making money thinking I was a genius. So the availability heuristic really needs to be something, especially for novice traders, that you have to be really, really cognizant of. This is next one is attentional bias. This one is a killer, guys. Okay, the tendency to be influenced by recurrent or distracting thoughts. How many of you guys watch CNBC during the trading day and end up making stupid decisions because Kramer said a thing, or I don't know, one of these talking heads? So that's really good. Well, a lot of you guys tend to suffer from recurrent thoughts. A lot of them are influenced by outside sources. A lot of you guys experience recurrent thoughts that are internal, like, I don't think I can do this today. And your brain, when you say something like that, when you experience that recurring thought, the brain always likes to answer why. And if you finish with a ... your brain will fill out why you can't do this today. So controlling your recurring thoughts through and avoiding attentional bias is absolutely essential to being able to focus on the true task at hand, which is being able to interpret that fire hose of information the market gives you so you can make decisions. All right. The illusory truth effect. The tendency to believe something by being repeatedly exposed to it. For example, believing that it is possible to trade with mechanical setups because many people act as if it is indeed possible. This is especially true in trading rooms where there's a guru and he's got a strat and an indicator that he sells you, and everybody uses it, and all of a sudden you fall under the spell of this effect as if you were trading in a cult. A mechanical setup is basically a setup way that has a few technical parameters, but does not include any kind of additional dimension into why it's a good or a bad setup. Does that make sense? A lot of you in the past may have been, I don't know, Fibonacci traders, and you were obsessed with fibs and Elliott waves, right? This is very common with Elliott. Don't even get me started on Gone traders. But Elliott wave traders, to them, everything is a wave, okay? And bro, sometimes a cigar is just a cigar, okay? But you're stuck in that perceptory jail due to the illusory truth effect. You have to break out of that cognitive jail, because sometimes it's an old lady, sometimes it's your wife looking away, okay? And the only way to break free from that illusory truth effect is to look beyond it and ask the right questions. All right. The mere exposure effect. This is another one that freaking kills trader. The tendency to attribute more meaning to familiar information. Believing cliches without getting to the source of why some ideas became cliches in the first place. So, mechanically buying RSI at 25 and using fibs mechanically as retracement targets. Has anyone seen these people on YouTube who just mechanically buy the market at a certain oversold level on the oscillator without any kind of context to that? This is an absolute death trap. And even though you think, okay, I am more sophisticated than that, this effect tends to rear its ugly head in the strangest of ways. Okay, and I have to safeguard against it all the time, because sometimes I'll look at a chart and I'll look at all the things that I want to see visually. Okay, and I'll see it's Tesla. She's V-bottoming off the 200 into a closing pivot. RSI is at negative 37. I mean, obviously it can't be, but it is what it is. It's very oversold, and I'm like, okay, I've seen this movie before 1,000 times, and I get complacent. Okay, the mere exposure effect gives you complacency, and then I fail to look at multi-time frame analysis. I fail to look at trend lines. I fail to look at the overall sequence. I fail to look at the fact that we're in a declining channel and nowhere near the declining line. And we've got maybe another 1.5 to 2 standard deviations to go, right? And because I'm used to, say Tesla opens higher, right? She does this all the time. She comes into that 5-minute 200, okay, bounces right there. I'm just trying to give some context to this right here, right? And you're like, oh, I've seen this movie before, right? And you buy her here. This is maybe the closing pivot, okay? But what you're failing to see is you're coming off a channel with a declining line, Okay, where that H setup, when this fails, that H setup is going to take you all the way down here to this prior pivot, right? And so because you tend to attribute meaning to familiar information and you get used to trading a stock, you will miss those things. Does this sound familiar? Or is this something people aren't struggling with? Okay. All right, cool. All right, next one. The mood congruent bias. This was also a freaking bear. So traders who have a lot of PTSD have this problem. So mood congruent bias. Changing types of memories that are triggered in the mind because of mood. Traders with bad experiences in the market entering a downward spiral more easily than normal if bad mood is present. Do you associate prior losses when you take a loss, maybe in any stock or a particular stock? I'll never trade. Yeah. So mood congruent bias is such a serious problem with some traders. Like, I was talking to a couple of you guys over the weekend, on Friday, not over the weekend, on Friday morning, and one of you guys was telling me, it's like I'm doing great in the morning. I'll take an opening range breakout, and I'll book in, whatever, $1,000 and probably doesn't matter, $20. It doesn't matter what the number is, and I feel great. And then I look for the retracement, and I get a beautiful I'll get a beautiful hammer off of the intersection of the the VWAP and the 21, right? So this is the open. They take a beautiful ORB here, okay, and then they sell right there, okay, and then they wait for the pullback. They got a 21 right here, and they get a nice hammer. They'll take the buy setup, okay. So now say they're up $100 on this trade, and they're up another $100 on this trade because it goes like that, okay, and then they get an inside bar, okay, and then they take the inside bar breakout here, and all of a sudden, they take a loss here, okay, and mood congruent bias kicks in. That loss, okay, will trigger a massive change in their mood and their confidence. And the problem with that, okay, is that in terms of your cognitive parallax, okay, so here's information, okay, and here's execution, okay, this cognitive parallax was working great, okay, you were sending stuff through, it was getting through because it was working, right, and then you hit a snag, okay, and that state of mind changes completely. Your confidence changes, your mood changes, obviously, it's a mood congruent bias, and then your ability to cognitively traverse the parallax to proper execution is shot, okay? The problem is that you're associating the current loss with prior losses, and you're associating your current emotional state unwittingly, okay, with prior emotional states. The problem with that, okay, is, like, say at a point in time, I don't know, in 2022 was a rough year, okay? 2022 was a rough year, okay? A lot of people have PTSD from 2022, okay? And your P&L went like this, okay? And October 2023, you started rebuilding, okay? And 2024 was crazy, okay? And for some reason, okay, every time you take a big loss, say you're trading Acme stock, okay, and you take some shares of Acme and everything's working fine, all of a sudden, you begin to associate the losses maybe you took in 2022 or whatever, 2023, whatever traumatic time was for you, okay, those keep on getting brought up, both subconsciously in terms of your mood, but also in terms of your beliefs, right? And the problem is that you may have been taking you may have been taking losses here because you were trading like a drunken sailor, okay, on meth. You may have been doing a terrible job trading here, and you took a third trade in Acme, you took that inside bar breakout, it didn't work, and if you're not acutely aware of this bias, okay, you're going to not only associate this mood here, okay, you're not only going to associate this mood here with what happened back then, okay, you're going to experience the same doubts and recriminations that you did then, even though you were taking a perfectly good trade that you should have been taking, when here you were taking terrible trades that you shouldn't have. Okay? So when you take a loss, there's a cycle to taking a loss, right? When you take that loss, you have to go through a period of evaluation. That's why I always tell you guys, if you don't evaluate your losses at the end of the trading day, what's going to happen the next day? Well, you're not going to be able to focus and cognitively process anything, because you're not sure if you took losses for the right reasons or the wrong reasons, right? And you keep making the same mistakes over and over. Does this sound familiar to anyone? That is why this is such a dangerous bias. You have to immediately assign meaning to that loss, or you will be a slave to this smooth congruence bias. Type 11 if this happens to you. You're doing great in the morning, okay, and you quit. You quit early, okay. You cut your day short, even though it's a beautiful day, because if you overstay your welcome, okay, your P&L is going to go like this. Sound familiar? Okay. A lot of you are doing this because you haven't fixed the problem of mood congruent bias. You haven't fixed this problem. You are inexorably altered in terms of your emotional and behavioral capabilities, and most importantly, your cognitive capabilities, because once you take a shot in the arm, you're not the same again that day. Mark Minervini talks a lot about championship mindset. One of the key differences between an amateur and a pro athlete is that a pro athlete doesn't suffer from mood congruent bias. They take a loss. Remember the famous pro golfer Tiger Woods. Okay, Tiger Woods' performance on a given match would, I'm talking about peak Tiger Woods. Okay, and then he would miss. Okay, rarely would he start downtrending when he was at peak performance. He would miss, bounce right back, reset his emotional state, and keep going. That is a difference between a performance athlete and maybe an amateur athlete. And it's certainly one of the key differences between a professional trader and an amateur trader. It's the ability to fight mood congruent bias among others. Completely in the zone. Yes, guys, is this making sense? How do you fight it, Duncan? You immediately have to ascribe meaning to the loss. Because if you don't ascribe meaning to the loss, your central nervous system will be like, oh, I know what this is. This is me trading like a drunken sailor in 2022, and I'm destined to repeat it, and I'm totally screwed because I'm going to repeat it. Instead of you saying, okay, that was actually a good trade, here's why it didn't work. Your biases are always going to be there, but you don't. Okay, this is your brain. Okay. This is your brain on apples. Okay? Each of these apples represents a thought, okay, or a bias, or an emotional reaction. You can choose, okay, so this was a rotten apple, okay? And you reach for an apple in the basket of apples. Do you have to take a bite out of a rotten apple? You are a rational, okay, analytic being. You can say, that was a good trade. I'm following my trading plan. I'm following my game plan. I traversed cognitive parallax correctly. The trade just didn't work. JDW, baby. Sometimes they just don't work, okay? We're in a business where if you're trading 70% success rate with high efficiency, you're a freaking god, okay? You cannot let 30% of the time make you reach for a rotten apple, okay? Do you understand what I'm saying? This is what mood congruent bias makes you do. It makes you reach for a rotten apple, but you don't have to. You can tell yourself, I took the right trade for the right reason, it just didn't work. And it just didn't work happens sometime, somewhere between 30 and 50% for some of the world's top traders. Do you guys know what Simons's winning percentage was in his hedge fund? Jim Simons, the pinnacle of algorithmic trading, one of the most successful hedge funds ever. It was in the 30s, man. Depending on the strategy they were trading and the time, it was somewhere between 30 and 35%. Yes, mathematician and physicist. Can you imagine if you were suffering from mood congruence bias, batting 300? You would destroy yourself, okay? We have, as traders, part of crossing that Rubicon is, first of all, understanding what the mind map of our biases is, what it looks like, and then having the presence of mind when you feel like they're about to kick in, okay, to actually choose the right apple, the right thought from the basket of your mind. Does this make sense? We're dealing with the why right now, right? We're trying to understand the why of things, and part of understanding the why is in that river moat full of alligators and sharks called cognitive parallax. We're understanding what the landmines are. Okay, this is a huge one. How do you combat mood congruent bias? Well, for me, it's assigning meaning. The reason I always tell traders, look, I can't teach you how to trade is because effectively I can't teach you how to overcome your own emotions, your own emotional baggage, your own biases, your own fallacies. Every trader has to figure those out by themselves. Everyone I have shared this with and talked about this particular bias about has shared the same thing, and it's assigning meaning to their trades. Okay, that's why a lot of trading psychologists will tell you, look, you need to look at your trades as a basket of 50 or 100. Okay, how many times have you heard experienced traders say, I don't look at individual trades, I look at my trades at 20 or 40 or 50 or 100. This is why, okay? If you fall prey to assigning too much meaning to any individual trade, when at best your win ratio is going to be 70%, 80%, and that's amazing, right? You're definitely going to fall under this problem, okay? The Bader-Meinhof phenomenon. Learning a new skill and subsequently seeing such a skill everywhere. Looking at you, Andrew. I even put a little ponytail on this one. Okay, learning a new skill and subsequently seeing such a skill everywhere. All of a sudden, to a hammer, everything looks like a nail. Have you learned a new technical analysis strategy or a new technical analysis indicator, and you start freaking machine gun spraying it all over your chart? You're like, oh my god. I remember, this is when I was still new to running a room, and I didn't know I should just, freaking slowly introduce concepts. So in 1 week, I introduced, Andrew's pitchforks and regression chant, and, all of a sudden, everyone was Andrew's pitchforking everything. And so the mind this is such a dangerous phenomenon, right? The mind starts to see that pattern everywhere, right? It starts to see it everywhere, and it becomes almost like addictive, right? It becomes almost addictive because of that concept we talked about earlier, the cognitive heuristic, right? Your brain wants to look at a bush and determine, is it a tiger or is it a bush, right? And our mind's desire to find patterns and simplicity in everything when we're dealing with a very chaotic multidimensional problem, it tends to lean on these indicators and falls prey to that temptation, which is incredibly difficult to overcome. So to a hammer, everything looks like a nail, right? And you see that in trend lining, for example, right? For example, when you're drawing trend lines, right? And we deal with this quite a bit in momentum mastery, right? So we'll have a trend line like this, right? And a trend line like this, right? And this is maybe somebody. Is that you calling me, Monica? No, okay. And you got you're maybe 2.5 standard deviations from the center line, all right, and then, because you're used to this particular type of channel, and we go higher, and then we go lower. You say, okay, well, this is an up thrust. This is a distributive up thrust, and you short the center line, thinking, okay, we're going to get a two-wave corrected down to the bottom of the channel, without thinking for a second that, okay, we may be just keeping our angle of ascent, and due to technical conditions, we now expanded our channel by another 2.5 standard deviations, and we're doing this. Okay. Does this make sense? So this is something that you really, really need to safeguard against, because it is incredibly tempting to try to bring order to chaos through external indicators, when the only order to the chaos we can usually bring to bear, okay, is through reaching some kind of some kind of maximum cognitive efficiency by bringing to bear the things that are really important in that case. And this is, I mean, I could go on and on about this because I see it all the time. Like the Fibonacci people and the Elliott wave people are like freaking famous for this. And Fibonacci at the end of the day is just measuring tape, guys. Okay, that's it. It's another way of just measuring deviations from the mean. Okay, and if you don't understand how price deviations work, Fibonacci isn't going to be particularly helpful. Make sense? Okay. The empathy gap. So this one, there's like the external empathy gap and like the internal empathy gap. So the empathy gap is the tendency to neglect the impact of primitive impulses in future behaviors and decisions. Okay. So a trader without a trade plan who lets their emotions get their full potential and therefore a point of no return with diminishing returns is reached. I feel like this one's pretty self-explanatory. I had a call with a trader today or yesterday who made a lot of money last year trading one of the big mega cap stocks, and this year lost a fraction of it. Not he's nowhere near red on it. He's a good trader, but that particular regression could very quickly turn into a massive sinkhole for him, And so, the empathy gap at work. Let's see. So, too high to hit rate. So, too high a hit rate, 90%, can mean too much loss avoidance. Yes, Jeff. So, a lot of traders, people should just type 11 because they know what's coming. a lot of you guys, okay, your hit rate is 90%, okay, and you have red days most of your days. Why? As in afraid to lose, yes. Why is that? Exactly. You refuse to take losses. So you build up a beautiful little day here. You're up $1,200, no losses. Okay? And then you hit that one loss, mood congruent bias, old MCB rears its ugly head, okay? And what do? You refuse to take that loss. And on one trade, you go from plus $1,200 to negative, I don't know, $4,000. Sound familiar? That's why you'll notice, guys, that a lot of really successful traders don't have 90% hit rates, okay? A really, really good scalper, like a professional scalper, will be able to do, I don't know, 60 to maybe 75% or 80%, okay? Something like that. It's very rare, okay? But their P&L curve looks like this. Why does their P&L curve look like this instead of looking like this? Okay, this is 90% guy. This is 60% guy. Small losses, big wins. It's very difficult. It takes a lot of skill to take lots of small losses and generate consistent wins for a variety of reasons. Number one is technical. A lot of traders who have a 90% hit rate, okay, have massive intraday drawdowns. So a lot of dudes, they'll find a trend, right? This is trade 1, trade 2, trade 3. Trade 4, intraday, their P&L on trade 4 looks like this, okay? They're trading like Palantir when it's running, right? And they'll buy the break of their prior trade 3. They'll buy the break of the break of day highs, right? And it goes through the 8, and it goes through the 21, and it goes through the 50. And at this point, you've got so many fallacies, biases, and fucked up emotions to deal with in your head. Sorry, Monica, you're gonna have to bleep that one out. That you've lost all control, right? But because it's a runner, it bounces, and you sell it barely green. You sell it up 2 cents, only to watch it go, of course, up $4. Okay, because obviously that's what's going to happen. Sound familiar? And so yes, at the end of the day, and you take a couple more scalps, and you make 6, 7, 8 cents per scalp. Okay, you make 6, 7, 8 cents per scalp. Okay, and at the end of the day, you look proudly on your 90% hit rate without realizing that this is a time bomb waiting to happen. Because if this trade had really gone, all the way down, you would have gone negative on the day, okay, and then you would have kept on doing really stupid stuff and gone really, really red on the day, okay? So it's mood congruent bias, then it's a pinch of Dunning-Kruger effect, and it's just the fallacies and biases and negative emotions keep on piling up. So this is difficult. It's difficult from an execution perspective, Jeff, because you have to really know your stops and execute cleanly to get those gains and take those quick exits. Right? You have to know where you're wrong. And a lot of novice traders, they'll scalp a really strong uptrend, right, until it pulls back and erases all those gains because they didn't have the execution chops to take those small losses because they didn't know where they should have taken those losses. Okay, That's the execution side of it, and of course the emotional side of that particular type of trade is the fact that once you take that loss, okay, as you know, Jeff, a lot of traders in the room are dealing with big losses from the February and December highs, right? And they're holding on to all that pain, and it shows up in their scalps, right? It's not just mood congruent bias; it's a lot of things. So they got one, when the market does well, and I'm calling out a runner, okay, they'll have a 1, a 2, a 3 winners, right? And then all of a sudden you get that liquidation break off a flag, and Nvidia or Donald Trump says some crazy stuff about trade tariffs, and they see their entire day go away because they can't take that loss. They just can't do it. You know what I mean? So it's a variety of things. So when you see a 90% hit rate, okay, you have to very carefully examine that, because that may be a Trojan horse, and you have to look at those numbers, and you have to look at win-loss rate, okay, is not important, okay? What you want to look at is your trading efficiency, okay? What is the ratio of in terms of P&L, in terms of winners and losers? If your average winner is 7 cents, okay, and your average loser is $1, okay, you have a massive problem. Profit factor. That's what I meant to say. Todd, excuse me. Todd is... Thank you. Do you see what I'm saying? Vet Trader says, I had to quit trying to trade everything. I picked 2 key equities a day. Excuse me, guys. And increased my profit rate substantially. Yes, that is essential to do, in my opinion, a Vet Trader. How many years have you been watching me trade? A while. So, symbolically speaking, your whole life. So says, this is the 1 share QQQ challenge, right? Make $1 then. Yes, what the $1, 135 challenge does, though, okay, is it lays bare your ability to reach technical targets and then take stops, okay? It is an execution and money management challenge, right? Are you able to take stops so that your wins are greater than your losses consistently throughout the day till you get to $1, then $3, and $5? Most people, when they go from trading bigger size to trading that 1 share, okay, it lays bare their psychological and technical deficiencies. You understand? Because a lot of you guys will do the following, okay? Speaking about this topic, okay? You're trading first of all, you're not thinking about risk units, you're thinking about tier size. So you're trading 100 shares, okay? You're trading 100 shares of Tesla, okay? And you made your 2 points here, and you make with another 100 shares of Tesla, you make your 2 points here, okay? So you're $400, and then Elon says some crazy stuff, okay? And you take a 4-point loss here, okay, on 100 shares, and now you're back to zero on the day, right? What is it that a lot of you guys do with your buying power? Jefferson Hoffman is getting Tourette's. Yeah. No, you don't double up. No, that would be too easy. You go from 100 to 1,000, okay? And you tell yourself, look, I just need that I on 1,000 shares, okay? I just need a 40-cent move to do what? What are you thinking about on that 40 cents? What are you trying to do? You want to get back to even. Nothing in the history of finance has wrecked more traders than the cancerous, toxic, poisonous thought. Okay? Get back to even. Those 4 words, okay? It's 4 dirty little words, have broken more traders than anything else I have ever seen. Okay, why? Because you are trying to regain emotional equilibrium rather than traversing the cognitive parallax to execution. Okay, instead of crossing that daily Rubicon. Okay, this is this is a professional route. Okay, what you're trying to do when you double up or 10x up, okay, is you're just trying to get your emotions back to a happy place. Okay, and as we have been discussing today, we are in terms of our emotional and cognitive makeup. Okay, we're made to run away from danger and pain, and that is going to be a very, very, very powerful, what's it called? A very, very powerful impulse. Okay. All right. Omission bias. Are you guys finding this helpful? Personally, I find this to be one of the most important things in trading that not a lot of people talk about. Trust me, when it gets to the actual tape reading, guys, we're gonna plug in these biases in real time. Okay. The tendency to think that harmful actions are worse than harmful inactions. Some actions seem comfortable in the short term, but have disastrous effects in the long term. Okay. For example, I just want to take 10x of my Tesla shares. I just want to make that $50 so I can go buy lunch, okay? And before you know it, that trade didn't work, and now you're down $800. Sound familiar? At the same pace, some actions feel uncomfortable in the short term, as in holding your trade to target, but produce good effects in the long term. Only key question is, what is the statistical outcome of your actions? What roadmap does it draw? In the heat of the moment, okay, we omit everything that doesn't have to do with the remission of pain. Okay? That is the omission bias. When you take that initial loss, okay? When you take that initial loss and you're feeling that mood congruent bias creep in, okay? And all of a sudden you get taken over by that Bader-Meinhof phenomenon that tells you to buy every single 21 because every single 21 is a gold mine. Okay, you're gonna need to fight that omission bias. Okay, so that you can stay, so that you can adhere to your trading plan. That's what the omission bias does. That is the mechanism. Okay, the omission bias is the mechanism that takes you from safe traversal of the cognitive parallax. Okay, to omitting your goals, your dreams, your aspirations, your roadmap, okay? And before you know it, 12 trades later and down another $8,000, you go, why did I just violate my game plan, my trading plan, everything I believe in, and betray every emotion I have and every value I hold as a person? That's omission bias, okay? A lot of you guys are God-fearing, spiritual, super dedicated, and very, very, very disciplined in your daily lives. You've fought in wars. You've taken people, you've reanimated people in ambulances. You've done some of the hardest stuff I've ever heard of, okay? And you've always stuck to your guns. You are the same person when you wake up in the morning than when you go to sleep at night. You are that same person. Your values never change, okay? It's not like you get out of church on Sunday morning and you go rob a bank, okay? You are completely congruent in how your values and your beliefs are reflected in your actions. That is not true in day trading, is it? In day trading, you have a game plan, you have a trading plan, you have a strategy you're trading, you're completely cognitively congruous, and 2 trades later, okay, some of these biases creeped in, and you're trading like a crackhead degenerate, aren't you? Why? Well, the gateway to that is your omission bias. Okay? We become girls gone wild. Wilson Chase, you say some things that I really want to unsee because you in a Girl Gone Wild outfit is just it's too much for Saturday morning, bro. I love you. Just saying. Go to your room. Absolutely. That's yes. Vet Trader says, do you realize that many of these biases are factors in survival situations? Absolutely. I mean, coming from our SEER instructor, right? Exactly. These biases will keep you alive in the African savannah 150,000 years ago. They will kill you dead in the market, right? That is why we crossed the Rubicon, Vet Trader. That is why we have a massive gap to fill in our cognition and behavior in order, the lizard brain, that's right, in order to transact in the markets, right? It is, our transactional fluency in the market really depends on us often doing the very opposite that a primitive human would do, right? We run toward danger and we quantify it and we work the probabilities, right? You know what I'm saying? Yeah, I mean, in the African savannah, a monkey person wouldn't look at a saber-toothed tiger and go, well, the first thing we need to ask ourselves is this tiger in an overbought or oversold condition, and is it near a demand zone? And if so, what is the likelihood? You know what I'm saying? Like, you run like hell. The market is really different. We run toward danger in very carefully quantified ways. All right, so that's enough. This one is a mother effer. This is a real trader killer. Again, it's a long road, guys. After today, I actually think it's kind of a good thing that we're gonna break after the cognition stuff, because it really is a lot to think about and absorb. When sometimes I get a little esoteric and a little sentimental, and I say there is no more mindful exercise in the world than trading, and this is why. Okay, because trading forces you to really confront your cognitive biases, fallacies, emotions, and choose, what apple to take a bite of, and that is the most mindful thing I can think of. Even though I'm not into that whole hippy dippy stuff, but you get what I'm saying. All right, another Andrew reference here. Andrew, you're on fire today, bro. I love me an apple. I love apples. Yeah, they're great. They're the greatest. I live next to Washington State, so we get amazing apples. Yes, patience always wins the day, Jeff. All right, the von Restorff effect. So many of these are German. It sounds like this is brought to you by Darth Vader. The von Restorff effect. Be the fisherman, not the bass. All right, so among an array of stimuli, people tend to perceive the information that stands out most automatically. For example, a market maker producing candles that stand out on the chart to shift attention of retail traders to a certain price area. The old inventory run, right? Well, we still have, as humans, as hunter-gatherers, a strong prey drive, right? How many times do you see a big green or a big red candle, and before you know, you didn't even think about it? If it's green, you hit buy. If it's red, you hit sell. Sound familiar? Right? It usually happens after that. So, yeah. So we're that little bass fish sometimes, right? Chasing the lure. The market produces a lot of signals, and we have to make split-second decisions as to whether to chase those or not, right? For example, I don't know if you guys remember on the 9th when Donald Trump made his fated comment about the pauses in the S&P 500 rallied, 270 points or something like that. Do you guys remember what I said to the room? I said, I don't know why I'm buying this, but I'm buying it, and I'm testicles deep. Okay. There's falling prey to the von Restorff effect, and then there's seeing something powerful in the market that you don't understand, but is real, right? At that point, the news hadn't hit the news hadn't hit the tape, okay? But we knew, or at least I was pretty convinced that something real was happening, okay? And it became a very high conviction trade. One of the keys that you're going to have to develop as a trader, okay, is knowing when to resist the violence and when to, quote unquote, dive into the violence, right? Like our friend Kelly always says. Well, that takes some experience, and it's going to take some tape reading skills, which we're obviously going to go into, okay? But the important concept here is that we tend to react very strongly to strong stimuli, right? We see a big bar, we want to do a big thing. Does that happen to you guys? You see a green bar, you get immediately excited, and you feel a sense of urgency, as if something big is going to happen and you're going to miss it. Yes. Technical arousal, chasing the squirrel. Right. So, this is the von Restorff effect. How many times, guys, do we see the market go in like this, right? And it's 3:45, and I'm telling you guys, we've got a late market liquidation coming. Okay, we got a liquidation break, late market coming. And what's the next thing I say, guys? Anyone who's been in the room long enough knows what I say next. I'll say, yeah, it's a profit-taking bear trap. Be careful. Be careful shorting this, okay? Why? Because I'm looking at the bigger trend, I'm understanding that a lot of traders are going to be looking to take profits. Stops are going to get run, right? When you build a P-shaped profile into a late day flag, okay? Buyers are buying the bottom of value. Sellers are building short positions at fair value here, okay? And market makers are getting ready to run the stops, okay? It's a trade for them, okay? And for the people, the victims here are people buying the bottom of value, okay? And the other people are either getting stopped out or taking profits, okay? That's what creates this supply-demand imbalance. Understanding that this is likely to happen is half the battle in fighting the von Restorff effect, right? Making a clear technical roadmap for the market as it is developing with a clear set of mapping guidelines, right? You'll often see me do this, right? Off a wedge, and I'll say, okay, we're coming into a wedge. We're in a distributive roadmap here, but if we take out this level, I'm looking for a two-wave corrective, and then if it holds the top of value in this accumulative zone, then I'm looking maybe for a channel formation, right? And I'll go on and on and on and on. Why do I bother to do all this? Okay, in part, it's so that I don't fall prey to cognitive landmines like the von Restorff effect. Based on what is happening, I can formulate an action plan based on my reaction to contingencies that I had already planned. That's why market mapping, some people call it market pathing, is so important, right? You're not coming up with a plan as things are going bananas. You've already have a contingency plan set, so that you're not getting very excited by big bars, okay? You're getting excited by big, nice, juicy retracements, right? All right. Which heart do you notice? Okay. All right. Next is the focusing effect. This is this is very common in novice traders. Especially, have you noticed how novice traders have a lot of beginner's luck? Novice traders seem to find the market very, very easy to trade. They have a very small sample set, and they're usually jumping into the market. Why are they jumping into the market to begin with? Well, because the market is going like this, right? They were not early adopters. They missed the markup, and they're coming in at the very tiny tippy top right before phase 3, right? Before a distribution phase of the market, right? This is everybody in 2000, right? And everybody in 2020, late 2021. You get it, right? And obviously these people eventually get smashed. They say they'll say never again. Okay. They'll say never again. Then the market does nothing, and they say, "See, I told you so." Then it starts to go up, and they're like, no, I'm not doing it. I'm not doing it. Frack, and they get right back in near the very top, and the cycle continues. You know what I mean? So, anyways, so the focusing effect is a tendency to place an exaggerated amount of importance in one event inside of a larger context. So, a lot of people will get very excited, okay? Very, very excited about their performance in a morning, right? Or their performance, their bad performance. They'll get very sad about having a losing morning and get very excited about having a winning morning. Is having one winning morning or one losing morning demonstrative of any kind of future performance? Is it really going to be? Predicting the future? No. Maybe you did well and you were taking terrible trades. Maybe you did badly and you did all the right things. Right? The market is like that. If you're a neurosurgeon, an indicator that you did all the right things is you don't have a dead guy at the end of the surgery, right? Usually, most of the time. An indicator that you're a piss poor surgeon is every time you perform surgery on a guy, he turns out dead, okay? Trading is not like that. Okay? You do not get always the immediate gratification of positive correlated results. 60% success rate. Exactly. So you're navigating that jungle, right? That minefield. That cognitive minefield all the time. And so the focusing effect is precisely that effect. It's very common with novices who become very overconfident, and just as easily as that overconfidence came, what comes next, okay, is the doom and gloom, right? 2022. Remember that? People went from $1 million plus accounts to below PDT in 6 months. Yeah, exactly. So it's a real bear, man. And why am I bringing this up? Given the fact that you guys, have been at this for a while, because it applies to all time frames. Okay, like I've got people who made 7 figures last year, and this year are struggling, due to recent pullbacks, and they're falling prey to the focusing effect just in a larger time frame. Okay, you need to be able to zoom out in this business, or it will eat you. It will eat you alive with a side of potato chips. All right, next, the framing effect. Is that a toboggan in your pants, or are you just happy to see me? So the tendency to react differently to the same information depending on how it is framed, right? So, for example, a lot of you guys will get very excited when you get a toboggan, right? And you're like, okay, we're going to short this sucker, and we're going to get to the secondary support pivot. We're going to make all this money. We're going to date Dallas Cowboy cheerleaders and buy mansions and whatever else. And what you failed to see there What you fail to see there is maybe you're building a curling wedge reversal. Maybe you're building an inverse head and shoulders. Maybe you're building a range and you're going to try to short the bottom of that range after getting stopped out here. And you're going to get 5 losses in a row because you were being stupid. Okay? Or let's just say not cognitively all there. So the framing effect is really, really important, right? You have to be able to frame things within your cognitive parallax with your maximum cognitive efficiency at all times. Okay? And you have to ask yourself, do I have enough information at, like, say, this point to make an actionable trading decision, or do I need to let this pattern, this structure, this cause, whatever it may be, give me more information to react to? The big problem with the framing effect, okay, is that it becomes worse and worse, okay, as you suffer from some of these other incredibly noxious biases, right? You're tilting, so you've gone full von Rostov effect on everything, right? And your emission bias is kicking in, and on top of all that, your mood congruent bias is through the freaking roof, right? And so you start seeing things that may be not there. Does that seem familiar? Do you guys ever start seeing things that are not really there as your desperation starts to intensify? And then at the end of the day, you've got that weird day trader post nut clarity, and you're going, what have I done? Okay, and it's a very expensive what have I done. Okay, you must find a way to control your urges, and the best way to control your urges is to mitigate having them, guys. Okay, that's what real discipline looks like. Mitigate creating those urges to begin with by choosing the proper apple, so to speak. Okay, so the framing effect is it's usually an after effect of all those other biases and fallacies that make you tilt and put you in a very, clean up on all three. Yeah, seriously, put you in a very, very bad behavioral place. The less is better effect. I love this meme. Minimalism is a scam created by Big Small to sell more or less. So the tendency to prefer simplicity over complexity despite explanatory power. This is a big problem for those of you who follow trading gurus online. Like, a lot of people follow Al Brooks. I love Al Brooks. I think he's the man. I don't know if he's a good trader or not, but he's made amazing contributions to the trading world through his careful encyclopedic documentation of price action. He is truly the Library of Alexandria of price action. He trades without indicators on his chart at all. Sometimes, if he's going wild and crazy, he'll put a 21 SMA on the chart just for shits and giggles, because he's really going wild that day. But he's really not an indicator guy. Al Brooks, okay, his point of maximum cognitive efficiency is a clean chart with no indicators. He just uses price and volume. The problem, okay, if you're learning from a guy like that, and I think everybody should read Al Brooks' books. I'm not criticizing him in any way, shape, or form. I think he's done wonderful things for the market. Is that your point of maximum cognitive efficiency, the things you need to see in order to traverse the perilous seas of your weird cognitive parallax, okay? They may be different, okay? Maybe you need to look at, if you're a standard deviation trader, maybe you need to look at Bollinger Bands. If you're an ATR person, maybe you need to look at Keller channels. Maybe you need to have VWAP on your chart. I mean, call me crazy, right? You've never heard of Al Brooks? Really, Green PJs? That's amazing. Okay, that's funny. Yeah, look him up. He's done a lot. Really, that's an interesting way. Anyways, the guy's done a lot of work with the big institutions. Yeah, they're very good. Yeah, as far as price action, I think he's the top guy. But anyways, so the less is better effect will often trap traders into believing that a minimalistic approach is necessary, when in reality, the only thing that's necessary, guys, is the things you need to see in the chart. Okay, a lot of you guys would be lost without VWAP and without the 21 EMA, and that's okay. Like, I've been doing this for so long, I can pretty much tell where VWAP is and where my mid-length, technical indicator is. I still find it helpful to see it on the chart. You know what I mean? I still find it helpful. I find that it helps me get a little bit more precise with my readings. You know what I mean? As a scalper, I find it super, super helpful. So, be careful with this one, because you'll trade with people that have nothing on their chart, and they seem to be doing just fine. And in the meantime, you might be getting absolutely destroyed. So, seriously, be very, very careful with that one. Okay. All right, next one. Empathy best. All right. Oh, this one's a pain in the butt. The Weber-Fechner law. This is the black mamba of day trading, guys. This one you have all fallen prey to. So the law states that the relationship between stimulus and perception is logarithmic. While stimulus varies geometrically, perception varies arithmetically. Okay, so going back to 8th grade math, okay. This is geometric versus logarithmic, okay? And so what ends up happening is that you're going to risk exponentially larger amounts of money while your perception of risk is numbed. This is super dangerous. Super, super dangerous. How many times, guys, have you, for whatever reason, okay, you start risking larger and larger amounts of money and you don't realize that your risk exposure is doubling, tripling, or quadrupling? That's because the relationship between stimulus and perception is logarithmic. Okay, there is a delay in your perception of that, and so you continue to risk more without analyzing your risk in time. It is extremely, extremely dangerous. That is why sometimes, as you're thinking about adding to a trade, or you took a great scalp, okay, and you're not absorbing that stimulus fast enough perceptually, you tend to double up because you're feeling good, right? You're feeling great. Well, you're not going to feel great much longer. All right, so that's why I call this one the black mamba of day trading. So, confirmation bias. I'm sure you guys are familiar with this one. This one's a doozy. It's the tendency to favor information that confirms your pre-existing beliefs. A trader who only sees a good side of his technique and ignores the bad side of it despite being exposed to it would be one example. Another, and some of you guys are really guilty of that, you're thinking about taking that Tesla trade, okay? And you hear me go long Tesla, and instead of taking 1,000 shares, you take 18,000. Some ridiculous amount, okay? And maybe I'm dipping my toes in Tesla, just building a position to see if it works. And you've gone full freaking hog, as if, there was a buyout offer at $18,000 a share or something. Sound familiar? Confirmation bias is super dangerous, okay? Especially because other traders may be taking that same trade for a different reason. Maybe I'm taking Tesla long because I'm hedging another position short. Okay, you have to you cannot fall prey to confirmation bias, and it rears its head in terms of other traders. Okay, it rears its head in terms of looking at indicators that are not really effective at producing solid results, but you see that you already have a bias, and you see that set of indicators flash, and instead of going through your entire analytical OODA loop, okay, for me it's the TOPS method, for you maybe whatever else, instead of going through that whole OODA loop to look at multiple time frames and demand zones and value, and etc., okay, you fall prey to that confirmation bias because deep down inside, your prey instinct is activated, your predator instinct is activated, and you just want to take the trade, and anything will trigger you into that trade, as far as bias is concerned. Is that, you guys follow what I'm saying? I have found, by the way, that this also extends to your physiology. I have found that traders who mouse over a buy or sell button because they were thinking about buying it are like, I don't have a study on this, but what I found is that they're drastically more likely to end up hitting that buy or sell button, meaning they're more likely to end up executing if they're physiologically holding the mouse and the button on top of it. And it's very easy for them to get triggered immediately the minute they see anything to confirm that bias. Like, at this point, Wilson Chase, I've worked with hundreds of you guys over these years, and I always ask, where was your mouse? What were you doing? And a lot of these people that pull the trigger too early, their hand was tense. They were white knuckling it over the buy button. Okay, this is a little buy button right here. Okay, and they were freaking white knuckling that key on their level 2. They're just getting ready to explode. Okay, so you got to be real careful with your physiology there. Oh, really? It's true for you, Jeff? Yeah, it used to be true for me too. I stopped doing it because of that. It's one of the reasons I went to hotkeys, believe it or not. That's really interesting. That's one of the reason casinos got rid of arms and went to buttons on slot machines. That is fascinating. Okay. What's your suggestion when you mention you're going long several names? But one's trading account balance is not, say, over 100,000, so it doesn't make meaningful profit just buying a few shares of stock only to sell them a bit later. That it doesn't seem to be enough time to even buy an option. Do you suggest buying leveraged products such as you could. I mean, trading leveraged products also presents challenges, Like, I find trading Tesla infinitely much easier than trading TSLL. But I also know that when I'm in TSLL, oh my God. It's, so, yeah. I don't have a good answer for you, Green PJs. When you have a $100,000 account, you really need to focus your efforts and maximize your leverage. You can't go basket shopping. That's just a fact. Again, that's my opinion. Okay, we are making some progress here. We got several more slides. Okay. Okay. The Semmelweis reflex. So this one, okay. This one particularly affects news flow traders. Makes sense, Peters. All right, so the Semmelweis reflex. This is really a news flow trader's worst nightmare, and that's why trading news flow is so difficult for some people. So the involuntary denial reflex that is triggered by evidence that goes against pre-existing beliefs. Discovering that you're on the wrong side while being certain that you are right. Easiest person to fool is yourself, says the quote. Okay, so example. Tell me if this has ever happened to you before. We hear some amazing news. Amazing news for, like, say, NVIDIA, right? I don't know. Chinese guardrails lifted. Jensen Huang rejoices in Luxembourg with Donald Trump. Whatever it is. Like, you think to yourself, okay, well, NVIDIA is going to pop 25 points here, okay? This is amazing. I'm going all in, okay? And you have a big, giant bar. And this is a 1 minute bar, right? And you buy near the top. And at the bottom, end of this bar, it looks like this, okay? And you tell yourself, well, whatever. That was just, early profit takers. It's going to be fun. Like, this news is incredible. This is the bee's knees. I'm going to become a millionaire. So you buy some more right here at support. Okay, you double up. And this is the 8. And then you start to bargain. Okay, this is a fool's bargain, right? It's another fallacy. So you buy some more at the 21. Okay, and you're like, well, this is a great deal. I'm getting it at the 21. Obviously, people haven't caught on yet. All right, and then you buy some more at the 50. And at this point, okay, you are averaging down like a deranged lunatic, okay? And you're suffering from an involuntary denial reflex, okay? The trade didn't work. You don't know why, okay? The market maybe didn't buy it. Maybe people didn't believe it. Maybe you have a seller pressuring the market lower. Ultimately, you don't know, okay? And the problem with the Semmelweis reflex, okay, is what? Is that you fool yourself into thinking that you have a complete set of information, okay? And you're thinking the market needs to do this, okay? But you know what? The market doesn't agree with you. And guess who's going to win if you go fisticuffs with the market, okay? Okay. So, how do we avoid the Semmelweis reflex? How do we avoid involuntary denial triggered by evidence that goes against post-existing beliefs? I do. When I realize I'm wrong and I believe it's going in a different direction, I do. Accept being wrong? Absolutely. What if we could avoid accepting being wrong altogether, Big Ops? What if we let that big candle go and say to ourselves, self, if this is the news they're saying it is, I can anchor. I'm going to make this color. I'm going to make anchored VWAP color blue. I can anchor VWAP off the igniting bar and either take a fast schematic if it breaks, okay, or buy the retracement to anchored VWAP. Does that sound like something we do with news flow like almost every single time? The most effective way of avoiding cognitive dissonance, fallacies, bias, and toxic emotions, guys, is to not expose ourselves to situations that would trigger them. Right? So in concrete terms, say we're dealing with a news flow story, okay? If it gets faded and pounded into the dust, we're not touching it. And if it holds our technical buy point, okay, either through a pullback to anchored VWAP or puts an inside bar or a flag or a pennant or whatever it is we're looking for that's a fast or reaccumulative slow schematic, then we're in it to win it, okay? But in both cases, we have one one word, okay? Confirmation. And we're not acting, we are reacting. We're putting ourselves in a situation where falling prey to the Semmelweis reflex is not even a thing that could happen on the first push to begin with, because we're just watching it. Does that make sense? This is one of the main reasons. I mean, obviously there's some news flow where I look at the tape, I look at the chart, I hear the news, and I'm in it to win it, okay? I am in deep. But not always, okay? And that difference comes from experience. There's no way around that. But Sun Devil, go to your room. How do you square this with also not falling? Why would I fall for mood congruent bias? Oh, in terms of feeling like you missed the trade and feeling like a chump again? Well, in the case of news flow specifically, that's not a thing. That's not how I think. You have a big igniting bar. If it's candle over candle, on the next bar, I'll take it long. If it's an inside candle, I'll wait and watch. If it's a flag, I'll let it build. And if it comes into anchored VWAP and holds, I'll buy it here. There's no missing the opportunity. I'm going to buy the candle over candle. I'll buy the flag if it breaks out. I'll buy the inside bar breakout or the 4-bar play if it breaks out. And if it fails to break out and holds anchored VWAP, I'll buy it here. So I'm not putting myself in a situation where through my own technical negligence I'm missing out on the trade. But more importantly, like, I don't know, I miss out on 150 trades a day. Like 200, like I'll look at my charts at the end of the day. I'm like, facepalm, like, oh my god. Google retraced the prior day's high volume point of control at RSI 97 with a shooting star, and I didn't take that trade. You know, what am I, a professional moron? You know what I'm saying, Ash? Like, you're going to miss a lot of stuff. Very expensive muffin. So, I think part of the secret is just accepting that there's a lot of things in the market that you're going to miss. You know what I'm saying? You can't kiss all the babies. You can't catch all the igniting bars. But the more important thing is what you focus on. At the end of each trade, you should look upon that trade and be able to say to yourself, I stuck to my guns. I stuck to my trading plan. And I did what I was supposed to do. Okay? And if you miss it, you miss it. You know what I mean? Because, again, in terms of mood congruent bias, like, maybe before you were missing trades because you were really, really slow, or because you were scared. You were scared to take the trade, so you didn't take the trade. The fact that you missed this trade today because maybe you were closing out Apple, or you were just sitting down because you took a bathroom break, has no potential correlation with what you were doing before. So having FOMO or you know, feeling denigrated by that is a complete waste of your emotional resources. Yeah, man, I used to be such a chaser. When it came to big trades, I was the biggest chubby chaser in the world, man. Horrible. Absolutely horrible. Okay. Are you guys feeling cognitively intact, or you get? That's a lot of information, right? Okay. The blind spot bias. I don't know why I went full Yoda and reverse these two words there. I'm sorry. There's a tendency to recognize biased behavior in others while failing to recognize biased behavior in yourself. So a lot of you have accountability buddies. You work together, which is amazing. If you're not working with an accountability partner, we have about 25 slides left, and then we're done for the day, Cellrex. Do you guys just want to power through here? Or you want to take a break? Power through? Okay. All right, so a lot of you, for example... Okay, I got it. We'll power through. A lot of you guys work with an accountability partner. By the way, if you're not working with an accountability partner, you 100% should, okay? There is power, and at the end of the day, being accountable to another trader that looks at your trades and goes, what the hell did you do today, okay? Email me, you can join us. Oh, you have an accountability group, Andrew? Nice. Cool. So I highly encourage you guys, whether it's Captain Ponytail or someone else, okay, to work with an accountability partner. Andrew's amazing. He volunteers his time to do that sort of thing with people. He's doing God's work. Thank you, Andrew, and everyone else on his team doing that. It's great. There's power in doing that, okay? However, the problem with that is that you sometimes tend to recognize biased behavior in others, and you fail to recognize that behavior in yourself, okay? And the problem with that is that you will start this weird cognitive dissonance where you're correcting other people's problems, and that in and of itself sometimes exacerbates yours. You start to develop real blind spots for that very same behavior you're doing in yourself. Anybody ever do that with a partner? And it creates overconfidence and inability to see your own biases, and before you know it, you have a real blind spot, okay? All right, the clustering illusion. Next up. Going through these as fast as I can, guys. There's about 20 more slides. 20 more concepts here. The tendency to see small clusters of information as valuable without considering the idea of statistical significance. This is, again, very similar to a prior bias we discussed. Is looking at small clusters of information. It could be in your performance, for example. Say, you took 5 trades that day and you have a 100% win rate, and you have, you have a 100% win rate, and, your trading efficiency through the roof, et cetera, and you say to yourself, I'm a trading god. I remember in 2020, late 2021, when the market started to get hard, started to get difficult, somebody emailed me an Excel sheet, and it was their extrapolated winnings in the market, okay? And it was, some ridiculous, they were telling me that by 2025 they were going to make $500 million, something insane like that, because they were obviously looking at exponential growth in their account. This person started with a $5,000 account, and they were up, I don't know, $200,000 by the end of 2022, 2021, and they were beginner trader. Okay, they just did not have enough data points in their training reports to really account for drawdowns and account for problems in the market and account for their own deficiencies. And so I was talking to this guy, and I asked him, remember, have you ever been through a drawdown? He's like, what's a drawdown? Literally, what's a drawdown? I'm like, what's a drawdown? Oh boy. That's when Eddie and I started calling market tops in late 21. We're like, okay, we have Houston, we have a problem. So, and this guy's, it was y equals x squared. It was a parabola or half a parabola. I mean, it was just wild exponential growth plotted like I'd ever seen. And this guy was talking about $500 million by late 2025. And I said listen, you're working with a very small data set. Like the market will come down, it will chop around. Do you feel like you're prepared? And he said, I have a strategy. And I was like, okay. And this person is no longer in the market. They washed out beneath PDT, and literally they had $500 left. They had $500 left to their name when I last spoke to them. Okay, so this one is a bear. Okay, and it applies to everything from trading performance to small clusters of indicators. Like, have you, for example, ever had you watch a YouTube video, okay, and Johnny Rocket's on, and he's got a strat that he's sharing that worked this week, and it's it's based on a small cluster of data points, and you're like, wow, that's amazing. So you're telling me that if I buy the 2-minute 21 or the 5-minute 8, I'm gonna get a buy setup triggering 80% of the time. That's amazing. And they show you their trade report, and it's verified and it's true, right? But then you have to ask yourself, if I had hit the buy button on these names at any point between 9:30 and 9:45, would I have had the same or better results? If the answer is yes, you're dealing with the clustering illusion, right? Do you know what I mean? So be very, very careful of Greeks bearing strategy gifts. All right? Make sure you question absolutely everything. Somebody comes to you with a strategy, is it back-tested? No. Get out of my face, okay? Come back to me when you've back-tested it for 3 years. Tell me how it goes. You know what I mean? Successful strategies, you're not going to find a successful strategy in the market that makes money 80% of the time. Very, very few. And if Johnny Rocket found it, he's sure as shit not going to give it to you, buddy. So, you know what I mean? If you had found a strategy that worked 80-90% of the market and made you money almost every single time, would you share it with anyone? Would you sell it? Why would you need to sell it? You know what I mean? So that's the clustering illusion there. Only to you, bro. Oh, thank you. Thank you, Andrew. I would also just sell it to you for $100,000. For the low price. Alright, so that's the clustering illusion. I'm trying to go quickly here because we have a bunch left, but these are making sense, right? Naive realism, the tendency to trust our senses without considering the possibility that we might be subjected to various types of illusions and distortions in perception. Again, this is Dunning-Kruger's redheaded stepchild. Okay, again, it's very common in beginners. Okay, and it's the ineffective deconstruction of complex systems into flatter systems that ignore really important variables. A lot of either new traders or traders that find like a new thing, like they find footprint charts or bookmap, okay, and has this happened to you where you see me bring out a new concept and you're imbued with this new hope, as if the Empire Strikes Back had just finished, and the rebellion, has a shiny new weapon, and we're finally gonna make it, mother effer. This is it. JR is my savior, and here's his new. Okay, that is all. That sentiment, that feeling you're getting, is naive realism. Okay. Exactly. Shut up, take my money, and sell me your indicator. So that is this. It's a fallacy, not a bias. Okay, but it's a really, really important one. There will be times in your career, especially when you're down and out, okay, where somebody is gonna do a webinar on YouTube and do this or do that, show you an indicator that's all of a sudden going to calcify everything, but you're mostly dealing with clustering illusion wrapped up in shiny, sexy new internet guru, okay? This is a really dangerous one. You got to be careful. And it happens in this room all the time. I show people footprint charts. They have an aha moment, and maybe they increase their edge on the market by 2%, but they feel like pissing vinegar the next day. They're like, behold, I am back with a flamethrower. And it's like, okay, you have new visibility into order flow. You have an increased edge in the market, but you feel like you're ready to take on freaking George Soros. You know what I mean? So you have to temper that new emotion down, or it's going to really hurt you. All right. Oh boy. Here we go. The gambler's fallacy. Bottom feeders beware. Okay. The tendency to think that increasingly large losing streaks increase the probability of winning of a winning trade in the future. This one is deadly, guys. This is the gambler's fallacy in action. So you see a rising 200, you buy the potential V bottom. It goes, but doesn't give you a V bottom. Gives you a lower it gives you a new high, but it's still a lower high, okay? And then comes in. And you go, alright, so it's coming in. I have a double bottom off of 200. Yay. So you're at 1x here. Okay. You double up here. And you think, alright, that's cool. We're going to get a W bottom and a two-wave corrective. Or, we're building an A1 wedge reversal, in which case I'm going to buy some more here off the bottom trend line, okay? And then I'm going to buy the breakout of the neckline, and I'll be 4x my tier size, and I'm going to crush it, right? In trades 1, 2, and 3, do I even have the remotest confirmation that that this reversal is going to work? Is the trend going up or down? Right. So the gambler's fallacy occurs when you're buying here, you're buying this potential double top, it fails, and you're like, okay, surely we're going to have to bounce off the 200, right? And maybe to spice it up and even throw you off a little bit more, it's the primary floor trader pivot. And you got a closing pivot. Oh my God, it's a point of control. Holy effing crap. You're like, okay, I'm backing up the truck. I'm going to buy the pivot. I'm going to buy the retest. I'm going to buy this higher pivot low because surely this must be an A1 wedge reversal. And I've been losing so much on this trade. Clearly we're due for a reversal, right? And your ill-fated A1 wedge reversal turns into a big fat H. And now, instead of being down $500, say, okay, you've quintupled your tier size, and you're down $2,000 without ever having a single true inkling that you were going higher in terms of confirmation. Anybody experienced this particular joyful fallacy in their trading? Yeah. I used to be a huge bottom feeder. It's a problem. So, guys, this happens. This gets triggered, okay? This gets triggered especially, okay, if you're an easily triggered trader, okay, and you have a lot of negative experience, okay, and your mood congruent bias is kicking in, and you feel like you're starting to trade compulsively because you're just at this point, right? When you're buying this, you bought this potential V here. Be honest. When you're buying the retest, are you buying the retest just to get out, break even here, or are you buying the retest because you're really building a position? Have you made a technical case? Have you traversed the cognitive parallax? Or are you going, holy crap? Okay, let me just buy the retest and get out for a little bit of money or break even here, and whew, help me Jesus kind of moment, okay? The gambler's fallacy really kicks in once the tilt is in full bore, okay? Like a jackass, you bought the double bottom because you're fixing this problem, or trying to fix this problem, instead of just taking your loss like a man, okay? And now you're really getting stupid, okay? You're buying this confluence of indicators, and now you're hoping that you're going to get a full leg higher so you can break even on these two, but these are two tiers, so you have to double your tier here, so now you're 2x, right? And then you're doing this whole A1 reversal thing, hoping, keyword hoping, that, you get back to break even or you make some money, okay? This is how accounts are wrecked, through the gambler's fallacy, okay? Knife catching is not for professionals. Yeah, been there. Yeah, we've all been there. Most of the time was to break it. Yeah, exactly. There's very few traders, okay? It takes a special kind of person. And I don't think it's good or bad. It takes a special kind of person to buy this double bottom who's really building a position. It took me years to the point where I had the emotional constitution to be able to pull this trade off correctly. And it's a hard way to make money. Okay? Just wait for the Evel Knievel, wait for the flag, wait for something, some kind of accumulative schematic that's going to give you confirmation, Duncan. I mean, that's why I wrote Momentum Mastery Volume 1 for you guys, is so that people wouldn't do this kind of nonsense. Alright. Next, so we got the gambos. Oh, the hot hand fallacy. Oh, this is an account wrecker. Oh, what a stinker. The tendency to think that good luck is sustainable. Anybody had this experience and therefore worthy of being used as a controllable tool? You're now Thanos. You're a master of destiny. You're on a hot hand. You cannot possibly lose. So a trader producing winning streaks, believing that he can control his luck to unrealistic degrees. Have you ever been on a hot streak where you're just winning, and before you know it, you're falling full prey to the Weber-Fechner law. You're doubling, tripling, quadrupling your tier size, and you're increasing your risk to unmitigated heights, and your P&L goes from this to negative your P&L in one trade. Ever been there? That is a fallacy at around. The hot hand fallacy is super dangerous, guys. The market doesn't have to do anything, and we certainly do not control its fate, okay? I know what I'm saying is obvious, but at the moment, I've been a big victim of this one, especially on hot news flow. Okay, when you caught that early, Tesla, Elon caught smoking crack pipe in women's underpants on San Francisco's Embarcadero while beating up a baby. Some horrible news that only Elon could produce, and Tesla's crashing. And it's like, oh, and he was with Joe Rogan or whatever nonsense, and like you murder leg one, okay, and then you start selling that bear flag and you murder leg two, right? And you're not watching the oscillator. It's at negative 37,000 into a demand zone. And because you're so excited and you believe you're invincible, okay, now you quadruple your size and you're like, okay, I'm buying a Tacoma. You know what I'm saying? And you quadruple your size and Tesla gets shot out of a cannon higher as all the shorts who are actually crossing the cognitive parallax realize that you're into a demand zone. And now, not only have you lost all your gains, you've gone deep right on the trade. That's the hothead fallacy at work. It's not a pretty picture, people. All right? At least now I can put a name. It's not about putting a name to them, vet trader, as much as it is identifying the proper behaviors so that you can sidestep those landmines, right? Like, I don't care if you guys remember the name, the Semmelweis reflex, okay? I care that you guys sidestep that landmine, okay? That you understand your involuntary reflex to chase a big green bar, and you wait. You know what I'm saying? Okay. All right, the bandwagon effect. The tendency to trust ideas more just because they are held by large groups of people. Traders getting into the market because cliche techniques out of fear of missing the bus. So, how many times... There's a lot of traders that have been here for a while. You guys remember all of the technical fads that have come and gone. You know what I mean? Like, when Bollinger Bands became really, really hot again in like 2010, and when everybody started trading the SMI instead of stochastics, like, these are just bandwagons that form. Right, exactly. There's always something new. You know, they're just different ways of getting through the parallax. Like, I always tell people, I don't care what indicator you're using, what strategy you're using. The only question that matters is, are you making money consistently and seeing the market clearly? That's the only thing that matters. I could care less what indicators or strategies you guys are using. I'm not here to sell you guys a strategy. I'm not here to, say, okay, buy the Geronimo 8000 and it's going to be easy. Nothing about the market is ever easy, guys. It's not easy. It's not effective. It's not simple. Okay? It's very, very complicated, as you guys have found post-2022. All right? The question is, can you avoid the tendency or the temptation to trust ideas without testing them? Just push buttons. The most people will not backtest ideas. What's worse, most people will use indicators without understanding how they work. Hello? You know what I mean? Like, if you're using for example, one trending indicator that works on ATR, okay? And then you're using a volatility indicator that uses standard deviations. Like, why are you doing that? Okay? You're going to get really different readings from one indicator versus the others, when in reality you're trying to capture one data set. If you're an ATR trader, you should stick with ATR-based indications. If you're trading standard deviations, you're talking to me, you should stick with those. You know what I'm saying? Understanding how your indicators work, guys, is essential. That's why the bandwagon effect is so dangerous. Certain things tend to work really, really well for limited periods of time. Everyone gets excited about them and publishes them on the market. But what they're really publishing is just a mere correlation. Remember the cluster effect from like 20 slides ago or whatever it is? That's the effect you're actually enjoying. So you really have to understand how your indicators work. Okay? Serious question about backtesting. There are so many variables associated with the market. Structures,
Mm-hmm. Structures associated with different time frames. Is this a day and a choppy day? How do you take all those variables into account in a backtest? I have struggled with this for 20 years, John. I could talk about backtesting for 3 days in a row. I could seriously sit here at 9 in the morning and start talking about backtesting, and without a break through lunch, keep going till 4 o'clock for like 3 days. Never underestimate the power of stupid people. Can I borrow that, Arnie? That's amazing. We're gonna have to have a talk on backtesting. I have a lot to say about that. There's a lot that goes into backtesting, and 99% of people, in my opinion, do a piss poor job at it. I had the privilege of actually sitting next to a group of very ornery quants, who were all math geeks, and got my ass handed by them for a couple of years until I understood what they were doing. So, yeah. All right. All right. The zero-sum bias, another ass kicker. All right. The tendency to think that financial markets are a zero-sum game. Markets are not zero-sum games because markets have an objective layer, nominal price, and a subjective layer, sentiment. The relationship between nominal price and market sentiment fluctuates. Correct. There are some times, okay, say for example, remember when Palantir was trading at like 270 times earnings? And, everyone wanted to short Palantir. I remember my buddy, my good buddy Derek shorted Palantir, and everything about the chart screamed short, and they were basically dunking on their own shareholders, saying that they were gonna, they were not gonna do any insider sales, and they were gonna promote the stock price, and all of a sudden, and that same day they published a massive stock sale by what's his name, the CEO, Mr. Nerdy Glasses Man. What's his name? Carp, yeah. Anyways, what did Palantir continue to do after that? It continued to go higher. There was a massive disconnect, okay, between the objective and subjective layers of the market. The market is not a zero-sum game. A lot of you guys will pass on phenomenal trades because you're going to be looking at some zero-sum bias, and some people, like, they won't take Tesla past $262 because they believe the fundamentals aren't there. Look, if people are buying it and the chart's moving, okay, it's going higher. You know what I mean? Yep. GameStop, exactly. Look, my mentor used to always say, he would paraphrase the phrase, the market can say irrational unless it's solvent. He would say, the market can remain stupid a lot longer than you can remain stupid. And truer words have never been spoken. All right, so the zero-sum bias there, hard at work. All right, next, hindsight bias. Sorry, guys. Fool's gold and false confidence. The tendency to perceive events as predictable only after they happen. This is a real problem. Oh, yeah, hold on. Is that better, Andrew? Yeah, sorry about that. The tendency to perceive events as predictable only after they happen. The biased hindsight analysis is completely useless. Unbiased hindsight analysis can be a good learning tool. How many times do you guys look at a chart you look at a chart at the end of the day and you go, oh my god, how could I have possibly missed that? It's so clear and so easy. Clearly, what happened here is Jim Cramer got on the horn at CNBC, and right as the market was touching the lower 60-minute calendar channel, and we're touching a demand zone, Cramer got on the horn, and obviously that was a very, very easy trade to take. And next time I see that, I'm going to take it because causality is obvious in this chart. Okay, there's a logical fallacy, post hoc ergo propter hoc. Have you guys ever heard that one? Post hoc ergo propter hoc. It's basically when it's another logical fallacy. Basically, it's when an event is presumed to have been caused by a closely preceding event, merely on grounds of a sort of temporal succession. Some people call it the post hoc fallacy, or the post hoc ergo propter hoc fallacy. This is tightly associated with this one. Okay, we tend to look at charts. Okay. And instead of looking at the important things, which are, demand, supply, structure, and order flow, okay, all the stuff that, Steinermeyer and Dalton and several other traders really focus on, which is the true supply-demand picture of the market, okay, they look at movements in the market, and then they find all these indications, all these indicators that confluenced at one point, and they look at the chart at the end of the day and say, okay, this happened because of Cramer and because of the 21 EMA and because of this and that and the other thing. And, those decisions look really easy in hindsight, but in reality, looking at the market, it would have been really difficult to say, call a bottom there. And the problem with this hindsight bias, guys, is that it's completely useless, okay? Because you see that confluence of indications, and it seems really clear in hindsight. But in hindsight, a variety of things could have happened with that chart, okay? The market, on Cramer's comment, could have shorted his comment. Jerome Powell could have come out and said something. Or maybe buyers may have not stepped in, okay? So this hindsight bias creates a really sort of incomplete technical picture and creates really bad habits. That's why I always tell you guys, looking at the charts is important if you're looking at them correctly at the end of the day, but you have to resist the temptation of using hindsight bias to say, well, of course the market bounced here. It doesn't have to do so, and unfortunately, we have the tendency to aggregate data points that look like they were the cause of an event, but may not have been at all. Okay, they're just, they're not it. So hindsight bias, really, really important. That's why I always tell you guys, instead of looking at the chart, replay the chart. All right, cover the right side of the chart with a piece of paper and tell me how that chart is gonna play out. I did that with my son all last summer, and it was very interesting to see him starting to form biases without knowing what was going to happen. I have to go now. All right, you got it, Way. All right, so a very, very dangerous bias. In my opinion, a far more fruitful exercise is to replay the market. Okay, a lot of the decisions we make aren't based on indicators. They're based on structure. They're based on order flow. They're based on how the market is moving. They're based on the subtleties of behavior as causes begin to form. You guys will notice that we call a lot of really accurate bottoms and tops in the market every day. Okay, we're really, really good at that. The last thing I look at is indicators. Okay, it's not the first. Okay, the same thing goes for mapping out volume profiles. At the end of the day, okay, you'll see a volume profile that's a beautiful, wonderful little P shape that's sexy with a bottoming tail at the end of the day, and you say to yourself, "Yeah, oh my God, how could I have not bought the close for a gap up tomorrow?" And you wake up tomorrow and the stock's gapping up, and you're like, "I am such an idiot." Well, the thing is, maybe you had to leave at 1 o'clock, okay, and this profile didn't look like this. It looked like this, okay. It looks very, very different. It looked like not like that, but it looked like maybe like a kind of really scant sort of, not a lot of volume here, not a lot of volume anywhere, and you're thinking, okay, this is going to end as a kind of an ugly B-shaped profile before the end of the day, and you're just not sure, and it's really sometimes very difficult to make that decision, and hindsight bias makes you feel really, really dumb, and you should really avoid that temptation, guys. I guess I have a lot more to say, but we're going to run out of... We're in slide 60. There's 300 slides in this volume. We're going to get to 75 today, and then stop for the day. If indicators are not the priority, how do you identify expected value high, expected value for the day in TradingView? I don't do that in TradingView, Anthony. Outcome bias. Oh boy. My comment here is just don't. So you bought that bull flag, you shorted that bear flag, you bought that flat top base, okay, and then you start to analyze the quality of that decision based on the outcome, okay. The quality of your decision doesn't have to be based on the outcome in the short term. The quality of your decision needs to be based on the process. This is really important, guys. If you base the quality of your decisions in hindsight based on the actual quality of the decision parameters you had, and you are able to say to yourself at the end of the day, I would take this trade again, your cognitive parallax the next day is going to be much clearer, okay? If instead you say, oh, I am such a dumbass, I took this trade and it didn't work. Okay, a trade not working, I know you guys know this, okay? But you know it, and sometimes you don't know it. Sometimes you don't know it behaviorally. When you judge the quality of a decision based on its outcome versus based on the process, it creates a tremendous amount of confusion in your head, okay? Because you're not sure if you took the right trade for the right reasons and it worked, or you took the wrong trade for the wrong reasons and it didn't work. Coming to clarity at the end of the day, okay, will alleviate outcome bias almost completely. That's why I tell you guys, journal your trades, figure out what you did right, figure out what you did wrong, because the next day you have that same setup and you don't take it and it works. What are you going to be feeling? What emotions are you going to be experiencing? You had a conversation with Grok? Andrew, you need a girlfriend, bro. Can we not talk to Grok as much? Can we talk to humans? Look, yes. Todd, ultimately, at the end of the day, okay, big picture, we need to make money, okay? And your P&L at the end of the day is going to be demonstrative of success or failure to a large degree. But at the everyday level, okay, if you have a proven track record and a proven strategy that works, okay, you need to be able to tell yourself, I took the right trade for the right reasons. Maybe this trade isn't working in this market and you need to reevaluate that, okay? But judging the quality of your decision itself is an emotional death trap. That's what I'm trying to say. You know what I mean? It's a real emotional death trap. All right, restraint bias. Here we go. Another not so silent trader killer. The tendency to overestimate the ability to control impulsive behavior. All right, a lot of you guys trade without stops. And I don't mean like a mental versus a hard stop. I mean, you degenerate monkey people. You guys are trading without stops, okay? You're so overconfident that you're dismissing your trading plan and just improvising your emotional apparatus, vastly overestimating your ability to control impulsive behavior. What ends up happening to people with restraint bias? Say they take that buy setup, okay? And, they're super confident. This, by the way, happens after what? A lot of hot hands, right? Say you're hot on Monday, you're hot on Tuesday, you're on a roll on Wednesday. On Thursday, are you a little bit more likely to maybe put down your guard a little bit? Maybe say, what do I need stops for? I'm a golden trading god. I'm invincible. What happens when your restraint bias kicks in and you're not really putting in stops? You're improvising your emotions. What other problems start to kick in? You go full gambler fallacy, right? You let that trade go from the 8 to the 21 to the 50. You buy it to 200, right? You are... What else is going on? A little confirmation bias, right? And ultimately, full tilt, right? Mood congruent bias kicks in, and you go from I'm a golden god to oh my god, I'm a loser, I will never succeed at this in 10 minutes. I have seen it happen. I've seen people go from hot streaks where they're up $100,000 by Wednesday to Thursday they're down $200,000. It is insane, okay? When I start to feel euphoria, okay, I reach out. Eddie is my accountability partner. When I start to feel like I am losing restraint because I'm so overconfident in my trading, I will send Eddie a picture of my positions and P&L and tell him if you see a change between now and the close, I will give you $1,000 because I'm done trading for the day. Okay, the best way to avoid these traps, guys, is to never step into them to begin with, right? Crying in my chair, I've done that many times. I found planning my exit before I make the buy has worked, while to stop impulse selling or planning the buy before the price. Okay. Yep. Agreed, sir. The overconfidence effect. Oh boy. This is another one of Dunning-Kruger's ugly red-headed stepchildren. The illusion people have that their subjective interpretation of their own abilities is positively greater than the objective measurement of such abilities. Oh boy. So you caught a big news flow trade in Visa. You're up $30,000. You come in the next day, all right? Winning is a funny thing. It imbues you with confidence. Sometimes confidence that's deserved, and sometimes confidence that is wildly undeserved. And what ends up happening when you have undeserved confidence, say from a news flow trade, or you're in a position that's a buyout, and you gap up and you're up a bunch of money, okay, is that even though you rationally understand that, you hit a home run because maybe you're in a good news flow trade or a buyout, okay, you rationally understand that doesn't change all the crappy trading you've been doing for the past month. But somehow that gain imbues you with a totally subjective interpretation of your abilities, right? There's a mismatch between what you think you can do and what the market knows you can do based on your results, right? And what ends up happening, most of the people I've seen with overconfidence effect, okay, not only give back their gains, but experience further losses. Okay? It's like 2020 meet you meet 2020, right? Like a lot of you guys had this overconfidence. How many of you guys were buying the first pullback to the 21, stepping away from your desk, going to the bathroom, making some waffles without a stop on? Without a stop in place. I remember people stepping away from their desks, 5,000 shares of Microsoft, 10,000 shares of whatever, not even a stop in place. I mean, that's how crazy the euphoria got. So when you feel euphoria, ask Jeff, what's the next best thing to do? Texting Eddie. After texting Eddie. For me, look, I can only tell you what I do. I tear down. Okay? Like, this last last Wednesday, I had a huge day on the Powell stuff. Like, big day. Like, we nailed the Tesla short. We nailed the S&P short, right? The following day, Jeff, like, I was down a little bit. I didn't even bother trading out of a small red day, right? 'Cause what was I really fighting? What was the battle in my brain? Okay? The battle in my brain was falling prey to euphoria. Okay? So I just slowed down a little bit. Yeah, I was sizing down and I took a small loss, right? And it would have been really easy for me to start tilting, say, all right, I'm just going to take a quick 5,000 shares of Tesla, catch 40 cents and get back to break even. That is the beginning, dude. That is the beginning of the end. You know what I mean? All right, next. Overconfidence is bad, guys. You're going to feel the euphoria at one point. You're going to feel invincible. That is when you have to figure out what you need to do to bring your interpretation of your abilities in line with your results. Okay? Interpretation of your abilities in line with your results. Really, really important. All right. The big kahuna, the Dunning-Kruger effect. This is a tendency people with low level of information have to overestimate their abilities, and people with high levels of information to underestimate their abilities. You're never going to hear me say, you can make lots of money in the markets easily. It's easy, guys. Just follow this simple trading strategy, and you will be a golden god, okay? That's never something you're going to hear me say. People hear my pep talk, and it sounds something like this. You're most likely going to lose all your money if you don't get your shit together. It is very difficult. This is a very hard way to make a living. It is incredibly rewarding if you make it, but it is very, very hard. There is nothing easy about this business. Okay? Every time I have let my guard down, I have been humbled by the market in immeasurable ways. It is never ending as a journey, guys. It's not like you reach some plateau of nirvana and you're good to go. Okay? It is a constant, never-ending cycle of humble pies from the market. All right? The Dunning-Kruger effect is so dangerous because people look at, they suffer from the cluster effect. Okay? They are they suffer from their overconfidence effect that we just went over. Okay? They look at their short-term results. Okay? And they end up really, really getting hurt. And the same is true for seasoned traders, okay? Seasoned traders, the Dunning-Kruger effects affect seasoned traders in the opposite way. They end up suffering from analysis paralysis. And I've talked to market makers in this room, specialists who they hit a plateau or a drawdown and they cannot get themselves get themselves out of the ditch. It's a spectrum with opposite effects at each side of the experience spectrum. It's a gnarly thing to watch. All right, the Peltzman effect. That sounds like a sci-fi hyperdrive engine or something.
The Peltzman effect. Death by 1,000 stop-loss paper cuts. So, a lot of you guys have real problems with money management. I'm using this as an example. So you think you're mitigating risk, right? By compensating one type of risk for another, but you're getting the three amigos all wrong. Like, this is a real problem, like a real cognitive problem. So you have, risk, reward, probability. Okay, so you're maybe looking at things only as risk reward, right? And you find a trade. You find a trade that, you say to yourself, okay, well, if I catch this buy setup, I can catch a $30 measured move in meta, okay? The likelihood of that working without it backtesting the secondary pivot is maybe 5%. On a stock like Tesla or something like that, 10%, very, very low, right? So you set what you think is a good stop, and in reality, it's a ludicrously small stop, which ends up giving you like a 20-to-1, but it's not really a 20-to-1 if you engage probability. I mean, it is a 20-to-1 if it works, but the likelihood of that working is really, really small. So what you end up doing is you think you're being responsible by setting up all these stops that are maybe too tight or maybe not commensurate with the technical parameters of the chart, and then you end up taking, you think you're being responsible, but actually you're being wildly irresponsible, and you're taking stop loss order after stop loss order, and it's eating you alive. Has anyone experienced this particular joy? It's like, dude, it's like wading through a river full of piranhas. It will eat you alive. So, this one really has to do with, this one is deeply embroiled into technical analysis, okay? You have to understand levels well and expected value well. Probability. What is the likelihood of this trade actually working, right? So, like, for this type of trader, like, if they look at, the trade across ATRs, for example, right? On every single one of these trades, sometimes they'll catch, 4 ATRs, 5 ATRs, but they're shooting for 17, okay? And they're up 4 to 5 ATRs on a lot of these trades, and every single one of them ends up being a loss. And they take their stop because they were shooting for whatever, 17, 20, whatever it is, and it's eating them alive, and they're failing to see that if they had a more conservative reward to risk ratio, they would have been fine. They would have made plenty of money, okay? So this effect is super, super dangerous, okay? Especially when it comes to risk management. I can go on for an hour about this one, but we gotta keep moving. Whew. The hyperbolic effect. All right, pay attention to scalpers. This one's a son of a bitch. All right. Hyperbolic discounting. Anybody heard this term before? The tendency to prefer shorter and sooner rewards over larger and later rewards. So a lot of you guys love taking those 1-to-1 risk to reward trades, okay? You're just taking quick scalps all day long, okay? What I always tell scalpers is, listen, if you want to be a scalper, and I'm a scalper a lot of the time in the market, okay? You need to be right a lot. You need to be right a lot, number one, okay? And you need to respect, okay, your risk to reward ratio. What happens with novice scalpers, guys? You tell me, what happens with novice scalpers? Do they really adhere to their 1-to-1 risk to reward? Or do they maybe take it at half a risk unit or a quarter risk unit, or as soon as they see 10 cents print on their screen? Exactly. One trade, man. One trade wipes your day because you prefer shorter and sooner rewards, and that's fine, okay, if your trading efficiency and your win-loss ratio is correct. Okay? But it's not if you're doing silly stuff. Yeah. Yeah, it only takes one big loss to, chisel away. And this problem, hyperbolic discounting, creates something called sunk cost fallacy. Okay? You guys heard of sunk cost fallacy? Ever hear this one? Okay, well, the sunk cost fallacy of time is the worst. Okay, you've been working away all day long. You've been chiseling away. You're hyperbolic discounting up the entire way up, okay? You're winning 10 cents, risking 70. Winning 10 cents, risking 50. Whatever it is, okay? And all of a sudden, you take that big loss, okay? And the sunk cost fallacy kicks in. Now you have to make it back because you've been working your butt off all day to make all this money, right? You've sunk all this time into making this day what it is. You sunk all this money into making this trade what it is. You can't stop now, right? And then what happens? Behold the tilting gorilla, right? And you start doubling and tripling and doing really silly things. Exactly. So, hyperbolic discounting. This is hard. Jeff, you were asking me earlier about scalping and is a 90% win rate, is it a red flag? It is if you're hyperbolic discounting. It is if you're winning 10, 20 cents and risking 70 or 50 or $1. You know what I mean? Yeah. Again, I don't care if you remember these terms, brother. Okay? I care that you recognize the behavior. You know what I mean? Okay. So here's the sunk cost fallacy. The error in judgment that arises from comparing past costs with future costs. And in this case, I was talking, of course, about the cost and time, which is one of the worst ones when it comes to day traders. Because tell me that if you've experienced this, you've been working your butt off all day long, you're up a bunch of money, you half of your day back, and now you feel like you're owed that money back because you put so much time into the market that day. You've been at it since 9:30 in the morning, and it's 3 o'clock in the afternoon, and now you're pissed, right? Sunk cost fallacy will cost you a lot of money if you don't get it under wraps. All right, now we're getting into the 800-pound gorillas in the room. What I want you guys to think about, okay, is I want you guys to start thinking about the chains of fallacies and biases, okay? Okay, so you've got hyperbolic discounting. Okay, that leads to the sunk cost fallacy, and the sunk cost fallacy leads to irrational escalation, okay? The positive feedback loop that happens in a series of decisions that produce bad psychological emotions. Unusually long losing streaks was an example. So imagine this, okay? You've got the hot streak fallacy going on, right? And you're full Dunning-Kruger, okay? And to make it worse, you've got the Peltzman effect going on, right? You've got tight stops, but hopefully you haven't been stopped out. But you're hyperbolic discounting, and all of a sudden you take that one loss, and now you're full sunk cost fallacy in, right? And then you go to irrational escalation, aka tilting. Okay? This is death to any trader. This is the worst one. Okay? Type 11 if you've never tilted. Go ahead. I just want to see who in the room is full of shit. Big ups. If you type 11, you're you don't pass the lie detector test. All right? So, the purpose of these slides, guys, is not so you nod your head and go, wow, this is really smart. JR read a psychology book, okay? You have to put these biases and these cognitive biases and fallacies and emotional reactions in chains so that you could recognize them, okay? You're on a hot streak? Okay, I'm on a hot streak.
Well, I'm more likely to start getting delirious here and suffer from overconfidence effect. If I'm suffering from overconfidence effect, okay, I I may start to get hyperbolic, right? Do some hyperbolic discounting. Then I may go full cost, sunk cost. Maybe because of that, I start to escalate, right? I take more trades with bigger size, and now I'm in irrational escalation territory, okay? And your once beautiful day, because you failed to recognize, okay, the cognitive and emotional grip you were under, goes from here to freaking sub-zero negative, right? Very, very quickly. It is up to you guys to recognize these behaviors, emotions, and cognitive biases so that you can stop yourself before it's too late. Okay? You don't just pay the price that day, do you? You pay the price the following day. It's like a hangover. Okay? It's like going out on a bender. Okay? Sure, you lost a lot of money. Maybe you had your fun. Maybe because you're a gambler or whatever. How are you going to be able to perform the next day, the next week, the next month? Okay? How are you going to be able to perform? Okay? How are you going to be able to focus? How are you going to be able to avoid mood congruent bias? Remember mood congruent bias from like 80 slides ago? All right, traders with bad experiences in the market entering downtrend spirals. The price you pay when you don't avoid these landmines, okay, is not just the immediate price. It's not just reflected in your P&L. It's reflected in your emotional makeup and your ability to make decisions clearly. There's no worse feeling for a trader than coming into the market with no hope because they know or they feel they're destined to fail because they've done so before and they can't get out of that rut and they feel like they're not seeing the market clearly. That is the true price you pay beyond the P&L, and it's very destructive, guys. Trust me, I am a world-class gold medalist in this arena. All right, nobody's paid the price more than I have. All right, zero risk bias, death by 1,000 illusions, a perfect strategy delusion. All right, that was pretty dramatic. This one's pretty self-explanatory, right? The idea that risk can be reduced to zero in the market. This is very common with you news flow traders when you see a hot headline and you just max out your buying power before even looking up to see what the candle is doing. Okay, it's very common for traders who follow a room and they idolize a guru and they buy the strategy book and they buy the strategy course and they buy the strategy indicator. Okay, and then they buy the hours of therapy it's going to take to unscrew that light bulb. All right. So, zero risk bias. If you start to feel like your trades can't fail or your strategy is immune to the whims of the market, you are in deep in the zero risk bias rabbit hole, and I suggest you dig out as quickly as possible. All right. Finally, the couple more here. I'm going to leave the best one for last here. All right. The disposition effect. The silent, not so silent trader killer. The tendency to sell something that has increased in value to keep something that has decreased in value. Meaning, we have the tendency to sell something that has increased in its value to keep something that has decreased its value. Okay? What does that mean? Well, a lot of you will sell something as soon as it's green, and somehow when it's red, you give it every chance in the world. It's like, let's just go along and see what happens. You let your losers run, okay? You let your losers run, and you sell those hot 5-cent winners as soon as they're green, right? This is prospects theory in a nutshell, right? Remember Daniel Kahneman? Prospects theory basically stipulating that we're going to do a lot more to avert losses, okay, we're going to get a lot more joy than out of making gains for the same amount of money. and that is the biggest problem that a lot of you suffer from, and I certainly suffered from it for years. The issue, okay, is that in the chain of causality, in the cognitive chain of causality, okay, you fix the disposition effect. Like, say the disposition effect is here, okay, you're carrying the cognitive and emotional bias luggage of 5 other problems from before that you're not addressing, okay? By the time you're dealing with the disposition effect, I'm not going to say it's too late, but you got to deal with all this other stuff, okay? Do you see what I'm saying? The pseudo-certainty effect, the backfire effect, the zero-risk bias that's destroying you, your irrational escalation, like all these things are compounding into that latter problem, okay? It's a chain of causality, guys. It's an emotional and cognitive chain of causality, and you have to whip it in the butt before it truly takes you down, okay? Okay, did we do the pseudo certainty effect? So this is a tendency to assume certainty where certainty is impossible. Overconfident trader, assuming he knows the outcome of his trades with unrealistic degree of certainty. This is very common, again, in novices who buy trading courses and follow gurus, follow their trades, follow their strategy, and all this nonsense. You know, there's a saying, real men stand alone, okay? Real traders stand alone. You are on your own in this business. It's a very, very lonely business. You're only going to achieve success when you're able to cross the cognitive parallax, which is a unique fingerprint to your mind, okay? Everyone's cognitive parallax is different. When you cross that objectively on your own, okay, is when you're going to be successful. This is a very, very dangerous one. Finally, the backfire effect, the tendency to increase the trust in certain belief when contradictory evidence is presented to attack such a belief, okay? Very common with traders with cult-like mentality about certain theories, indicators, or trading gurus. Also, you're going to see this a lot in trades that are going against you, right? You're going to, you know, have you guys heard of the no true Scotsman fallacy? Okay, this is very similar, but in trading and economics, you're sometimes out of pure desperation. Okay, you're going to be like, okay, Fibonacci isn't working. That's just because I'm not Fibonacciing correctly. Okay, no, you're not trading correctly. You know what I mean? You have to zoom out. This feels like Mission Impossible. Well, let me ask you a question, Pablo. Do any of these problems resound in the things you've been experiencing in your trading career? Yeah. So you have to fix them. You know, whenever I've talked to successful traders or I've had successful mentors, exactly. Yeah. Your Aikido will work if you add a Glock to it, Andrew. If you add a Glock to Aikido, it's amazing. Yeah, always work. Anyways, what was I going to say? I've always had a moment with mentors and with traders that I look up to, or it's like a holy crap moment where I realize like all the work they've actually put into being the trader they are. And I don't mean this in an arrogant way at all, okay? But you know, you see a trader with their indicators and their tape reading and their trading strategy, and you go, okay, if I just do that, you know, if I copy what it is they're doing, you know, I'm gonna be successful. And what you're not seeing is the years or decades of work on themselves that they've put in order to execute. You know what I mean? You know what I mean, Pablo? That is the structure that undergirds you as a trader, is the stuff we talked about here. I mean, obviously there's the success pyramid we talked about earlier, right? Like you have to You have to improve your foundational principles, your technical analysis, your risk management, your execution. But then when it gets to psychology, cognition, and behavior, that is something very few people talk about. But that's really one of the keys that make people successful in this business. Managing their behavior, understanding their psychology and cognition. And that is the long road, dude. I could teach a monkey how to do a buy setup. Or short a shooting star. That is not the complicated part of this business. I could, I taught my kids hotkeys over the summer, and Harry's like, okay, yeah, so I'm buying half tier at the bid and sending a 30-cent offset, and he was like, that's what it sounded like. It's a video game generation. They're like, okay, all right, Dad, got it. You know what I mean? That's not the hard part of this business. It's not. So when they say trading is 99% mental, okay, or 99% psychology, I think that's what the stuff we're talking about is what they mean. So do some work on yourself, reflect, and start getting familiar with these impulses and mitigating them before they grab a hold of you. Half the battle, dude, is making sure that as you're technically traversing the markets, that you steer clear of the landmines. So that is the backfire effect, and this is our intermission. Well, we almost went to noon. Jeez. There's no way we would have finished before 7 o'clock today, Monica, because we got like 270 slides, and we did 60. Anyways, so just to recap, guys, why did I choose to why did I choose to go over cognitive biases, psychology, and biases, psychology, and fallacy today? Because when we're in an actionable decision mode, okay, there's very, very little time to think and act, okay? You have to be incredibly clear as to where you're doing what you're about to do, okay, and how you're going to do it. And the why is already completely figured out, okay? Well, getting to the why, okay, why am I looking at this trade? Is this trade going to be actionable? All these questions that you have to, filter through your cognitive parallax technically, okay, it must be completely unencumbered by cognitive or psychological landmines. And so the first step in being able to do that, guys, is understanding what they are so that you can actually identify them starting to creep up on you and avoid them altogether, okay? So anyways, I guess we're going to continue this volume 1 next week. There's a lot to go through. It's about 220, 230 more slides. It's a lot of charts. So you and your study groups. All right. All right, guys. Have a fantastic weekend, everybody. We'll be back Sunday night. As long as I'm not violently ill, we'll be back Sunday night for the market watch list for Monday, all right? All right. Thanks for joining us, guys. Love you guys.